Okay. So you can look, you can see that. Let me share my board. The the list question that we solved yesterday, the one on the foreign list. Okay, we did not consider the residual value when we were calculating the what the depreciation. Okay, the right of use is accounted for like any other assets as I've stated yesterday. So the residual value should be taken into consideration when we are calculating the depreciation, but that was an oversight and I didn't include it. But let me show you how to go about it. Okay, so the residual value should be considered. What you do is that your depreciation will be the the cost minus the residual value divided by the useful life. But this is a foreign list. How do you go about the issues of the residual life? I said the residual value. Okay. So the residual value is going to be paid at the end of the lease. So what you do is you just use the what? The exchange rate. You use the exchange rate at the end of the lease because the money will be paid to the what? To the lessor at the end of the what? Of the lease period. And the residual value is always estimated at the end of what? At the end of the lease. So what you do is you look for the exchange rate at the end of the lease and multiply it by, I'm sure the figure was 30,000. So if the exchange rate was 10 cities at the end of the lease, you just multiply by 30,000 and that will give you 300,000. And that will be the what? The residual value which you'll be subtracting from the cost of the asset before you charge the depreciation. I don't know the exchange rate over there, but that is how you go about it. All right. Yeah. Someone's hand is up.
Yeah, see now,
Yeah.
some of us are still at work, so you go through whatever we are done during the weekend. So the changes, no, I don't know if you have time during the week, you can do the changes at the board these things that you'll be sharing so that when we are going to, not find ourselves out.
I cannot write on that board again.
Oh, okay, okay, that's fine.
Okay.
That's
Okay.
fine. Thanks.
All right. All right. All right. So let's
Sir,
look
are you
at,
recording, sir?
yeah, yeah. Okay. So let's look at the specialized transaction and some issue on interpretation. Then we go. Okay. So we are going to be looking at specialized transaction. We are going to be looking at the internal reconstruction, and they have also added external reconstruction. But that one, I'll bring a question, then maybe that one I will inform you sometime, then we solve that one. But for now, we stick with the internal reconstruction and the business valuation. Then one question on ratio analysis, then we move on. Okay. So Auntie Vic, pick the question number one for us. Let's know the requirements. So prepare a statement of financial position after the implementation of the reconstruction scheme. So we are doing reconstruction. Okay. So you have to know that you cannot do reconstruction. Okay. The reconstruction, you are now what bringing the company to, or you want to start afresh. It's just like you started very well and you have now fallen. So you want to what? You want to bounce back. So you have to now let go of what certain things and now come fresh. That's about the reconstruction. So the company is going to be coming as a new company. Okay. But it will not be a new company with a different name. If it is coming with a new company with a different name, then we call that one to be external reconstruction. But you will be having the same name of the company, but the company is now starting as if it's a new company. Okay. You can't do this without preparing capital reduction accounts. The reconstruction, you are going to be revaluing the asset. You are going to be writing off, or you are going to be closing down certain what operations. At the end of the day, the restructuring can lead to a gain or it can lead to a loss. So you cannot do this particular restructuring without a capital reduction account. How or what is a capital reduction account? Capital reduction accounts is just like profit or loss accounts. So any gain or loss will be taken to the capital reduction account. All right. So since the question is asking you to prepare statement of financial position after the implementation of the reconstruction, what you do is it is the same figures that you are going to be taking, but you are going to be reducing some of them and you are going to be increasing some of them. So you can start with your statement of financial position with the same figures, open bracket and what, and put it there. Those that will be increasing, you add addition. Those that will be reducing, you reduce them with the figure. That is all. And some of them you do workings for them. Example like equity share capital. A lot of things will be affecting the equity share capital. So mostly we do workings for it because if you open space, the space cannot contain maybe the adjustment to the what to the equity shares. So mostly the equity shares, you have to go and open the equity shares account and then you do some workings over there and bring the figure here. So what we are going to be doing is the name of the company is the Kabua Limited. So we'll be having the name of the same company, Kabua Limited. Okay. Then we have statement of financial position. Financial position as at, or you can say immediately after the reconstruction, or you can look at the reporting date of the entity. The reporting date is the 31st December 2021. So you can say that you are preparing this on 1st January 2022. So the reconstruction will be done on 31st December. So maybe you can say immediately will be like first what? 1st January 2022. Or you can say statement of financial position immediately after the what? The reconstruction. So the reconstruction can take like it can take like 3 months. So the 1st January might not be applicable. So you can say statement of financial position immediately after the what? After the reconstruction. So after the immediately after the reconstruction. So we have immediately after the reconstruction. Okay. So you can have you'll be having your assets here. Then you have your non-current assets. You have non-current assets. Then you have your currency sign here. Then you have your currency sign here. Then you have your PPE. Okay. Just bring that value and come and add any addition or subtraction because the reconstruction, we are now bringing the asset to the what? We are sending the asset as if we are sending to a new what? A new company. So we send the asset at their current values. So we have the plant and equipment to be 22,000. Okay. So you have the plant and equipment to be 22,000. So you have 22,000 over here. If there's any increase, you come and add. So you have the trademark to you pick the same figure and put it in brackets if there's any addition. But if there's no issue about a trademark, we say that the trademark is what is worthless. Because if you are doing reconstruction, all tangible, all intangible and fictitious assets should be written off. Okay, especially goodwill. So if nothing has been said about the intangible asset, you write them off. Okay. So we have the trademark to be 45,000. So you put it in bracket. If there is any issue, you come and add or subtract. Okay. Then we have investment property. Investment property to be 12,000. The goodwill will be written off. Okay. But you can still bring it and come and subtract the figure that you are writing off from the goodwill. So we have goodwill to be 48,000. Okay. Then you have your current assets. Current assets to be, we have the inventories to be 108. So inventories to be 108,000. Then you go to receivables. Receivables will give us, let's pick the figure there. Receivables is 194,000. The cash and bank, there can be some workings to the cash and bank. So you leave it and go and do your calculation somewhere, or the cash and bank, mostly there may be a lot of issues that might be affecting the cash and bank. So if you open a space, that might not contain the adjustment there. So you can put the cash and bank there and go and read the footnote and see whether a lot of issues is going to be affecting the cash and bank. Then you bring them. Then we have the equity and liabilities. Okay. So the equity and liabilities, we are going to be having the equity first. Then we have the share capital. The share capital, to a lot of things will be affecting that one. So we leave it for now and see what we can do. Okay. So we having capital surplus. The capital surplus, so you are going to be writing. You are going to be writing off the capital surplus against the retained earnings. Okay. So you can actually put the capital surplus there, and then you write it off to the capital reduction accounts. So we have the capital surplus there to be 70,000. The retained earnings will also be written off. Okay. So you can put it there and come and write it off. So we have negative 5,000 as the retained earnings. Okay. Then you leave a space because there might be some issues coming there. You leave a space like 2 or 3. And at that one, then you come to non-current liabilities. So under the non-current liabilities, you have 12%, 12% debenture. So you bring the 12% debenture also there to be 150,000. Then you have the 15% long-term loan. That would be 70,000. So we have 70,000. You leave a space like 2, you have your current liabilities. Okay. So your current liabilities, you bring the figures also and put it in brackets before you go to the footnote. So you have your trade payables there. So you have trade payables. Trade payables to be 140,000. Bank overdraft to be 9,000. So 140,000. And bank overdraft to be 9,000. Then your workings will now be, so you start with your workings. The workings, the first one will be capital reduction. So you can't do reconstruction without capital reduction. The capital reduction is just like what? Profit or loss account. So if there's any gain or loss on the reduction, it is going to be determined from this particular or using this particular account. So you have the capital reduction account. So the capital reduction account, you have your debit and your credit. Okay. Your debit and then the credit. So we have something like this. This side will be the expense, and this side will be the income. Okay, so we can now take our footnotes one by one to see what will happen. Auntie Vic, are you there? Auntie Vic, Auntie Vic, Auntie Victoria. I hope someone can hear me.
So we can hear
We
you.
can hear you, sir.
Or she is not the one who can. She's the only one who cannot hear me.
Maybe he's at some noisy place.
Okay, someone should help us with the this thing, with the footnotes.
Additional information.
Okay.
The following asset values were relevant in liquidation. PPE, 15,000. Inventories, 88,000. Trade and other receivables, 160,000. Trademark, 60,000.
I have to change. This should not be liquidation. The following values are important in the reconstruction, not liquidation. Okay. So we are using the same figure. Those are the revalued amounts. Okay. So these were the revalued amounts. So this is the new value that we are going to be taking to the new company now, or after we have done everything. This will be the new value of the asset that we have in our books. So let's go there. We have 15,000 for property, plant, and equipment. How much? What is the net book value? What is the current value in the books of the entity?
22,000.
And they are saying that now it is 15,000. Okay. What is happening there?
You're devaluing
The
the
value
asset.
has gone down.
Okay. That will be a revaluation loss, isn't it?
Yes, sir.
So you bring property, plant, and equipment at the debit side of the capital reduction account. We are saying that the capital reduction account is just like profit or loss account. So we are going to be having 22,000 against 15,000. What is the reduction?
7,000.
15,000.
7,000. Okay. So what we do over here is we have to bring the asset to what? To 15,000. So we come and take the what? The downwards revaluation. This is a revaluation loss. So we come and write the asset down to what? Its market value now, which is a 15,000. So that's what we are going to be doing. We debit our revaluation surplus account, which is like reducing it, which is like a loss, which is like a expense. So you debit the capital reduction account, because the capital reduction is just like profit or loss account. And you'll be crediting the asset. The value of the asset will be reducing. So that is the first entry for this one. Let's take the second one. Inventories is 88,000. What is the value of the inventory that we have here?
108,000.
Okay. Is it going down or going up?
So it's going down
By how much?
by 20,000.
Okay. So what we do is we reduce the inventory to what? 88,000, and that will be treated as a loss to the entity. So this is what we do. So you come here and reduce the inventory by 20,000. Then you go to capital reduction account. Then you have inventory over here. Okay, you can bring the figure or you can be subtracting. Okay, so that will give you 108,000 against 88,000. And that will give you 20,000. Okay. Okay, let's come to trade and other receivables. Trade and other receivables. How much are we having for the trade and other receivables? That will be
Okay.
194
against
minus
160.
160.
Okay, the difference is what?
34.
30.
For
Okay.
34.
Okay. So that will be 194 against 160. That is 34. Okay. So what we do over here is this. Okay. So we have receivables. Please, you can just write the name and write the reduction there. Okay. But if you want to say
Yes.
the reduction is bad debt, there's no problem. If you want to give your own name to them, there's no problem. But this one, the best way you can go about it is to write the name of the item and write the figure. That will be accepted. But instead of you saying that bad debts or provision for bad debts, there's no problem. Okay, so you just write the receivables here because the only thing that will reduce the receivables is a bad debt. Okay, so that will be 34,000. Okay, so we come here and reduce our receivables by 34,000. Okay, so let's go to this particular. The next one is
Trademark.
okay, trademark. What is the value that we have in the trademark was?
No, was 40
Okay, now it is
against 60.
60,000. What is the difference?
15,000.
Increase or decrease?
Increase.
So that is an income to the entity, isn't it?
Yeah.
So we bring trademark to the credit side, and we have what? 15,000 as the difference. Then we go and increase the trademark by what? By 15,000. So that we now have the new value now. What will happen to the goodwill?
It should be written off.
Okay. So we are writing the goodwill off. The goodwill is an asset. If you are writing an asset off, that is what? It means that the goodwill is having a value of 0, which means that the goodwill has impaired by the full amount. So
Yeah.
let me bring the receivables here. So we will have the receivables here to be 34,000. Then you bring the goodwill here. That will be, you are impairing the goodwill by the full amount. That is 48,000.
8,000 minus
Okay.
48,000.
Okay. So
No,
we have
48,000.
48,000. So that will,
Yeah.
we go and write the goodwill off by the 48,000. Okay. If you are doing a capital reduction, okay, the thing that you have to write off first is the intangible asset, unless they are giving you what? A value or market value for that intangible asset. Assuming nothing has been said about a trademark, we also write off the trademark. Okay, and the retained earnings. The entity is making a persistent loss. They are making a consistent loss. That is why they want to what? They want to carry out the capital reduction account, or they want to carry out the capital reduction or the reconstruction. So you always have to. The company is coming new, so they are coming with no reserves. So there should not be any profit. They are now coming like new. That's what this is now. They are going to be starting. So no profit has been made yet. That's how we go about it. So the retained earnings will be written off completely. Okay, but we be going to that side and we think or we look at what we can do over there on the retained earnings. Okay, the two.
Footnote
Hello,
2.
sir.
The state.
Hello,
Hello.
sir.
Yeah,
Yes, please, can you share the paper question with us? Some of us don't have it so that we can follow alongside.
we have shared this thing on all our platforms in the morning. So if you are on any of our platforms, you just have to go and check.
Yes, I just joined this morning, so I don't have it yet.
When did you join?
This morning, I joined the group this morning,
Around?
around 8 a.m.
Okay. Sina, take the footnote for us. I will sort him out.
Okay. Footnote 2. The stated capital of the company is made up of 60 million shares at 0.85 per share and 9,015% cumulative preference shares of no par value. The shareholders are willing to write off 75% of the share capital in the case of any reconstruction.
Okay. So this one, this thing that they are giving to us over here, okay. Okay, you can see that. Let's go to the share capital of the entity. What is the value of their share capital?
60,000.
Okay, but they are saying that included in that particular 60,000 is what? Or the composition of that 60,000 is equity shares and what? Preference shares. Okay. So the question is saying that the preference shares is 9 million, isn't it?
Yes, sir.
So equity shares will be what?
The difference.
51.
51.
51.
You don't have to multiply. Even if you do 60 multiplied by 0.85, you'll be getting the 51 million. But you just take the what? The preference share. So what we are going to be doing over here is we are going to be separating the preference shares from the equity shares. So we come here,
Okay.
we bring the preference shares over here. I'm sure that is 15% preference shares. Okay, so we have the 15% preference shares. Then we have the 9,000 here. Okay, we don't have any figure on the share capital now, but we have to know that this will now change to equity shares. Okay, so this will now change to equity shares. Okay, so we come and do that particular one later. There are 51,000. We come and take that particular one later. Okay, the stated capital of the company is made up of 60 million shares at what? At 0.5 per share.
0.85.
Okay, and 9,015% cumulative preference shares of no par value. The shareholders are willing to write off 75% of share capital in case of any what? Capital reconstruction. The shareholders are willing to write off 75% of the share capital in case of any capital reconstruction. Who are those writing off their shares?
Hello, sir.
Yes, please.
Sorry for interjecting you. Please, I wanted to find out when you take the 60 million multiplied by the 0.65, you get 51 million.
Yeah.
So means the rest, the 9,000 is for preferences.
Yes, please.
Okay, thank you.
All right. Who are those writing off their shares? Who are they? Who are those that the question is referring to as what? As the shareholders.
Equity shareholders.
Okay, but
The equity shareholders.
this question is kind of what? It's kind of what? Ambiguous. Okay. If you are preference shareholder, you're also a shareholder. They will call you a shareholder. Okay, but basically in real life situation, shareholders are the what? Owners of the what? Of the company. Are you okay?
The business.
Okay. So for this reason, we'll come here. The 20% of the carrying value of the preference shares and debentures are to be written off. So because of this footnote, the shareholders that they are talking about over here will be what? Will be preference shareholders. Will be the ordinary shareholders rather. So it is the ordinary shareholders that are willing to write off the what? The 75%. But if there is no need like that, then please, it should be on both the preference and the ordinary because they are all shareholders. If you are preference shareholder, they also call you a shareholder. But just that shares will give you ownership. So if you also say that it is ordinary shareholders, fine. Because before they will call you a shareholder, it means that you are part of the owners of the what? Of the company. So the shareholders will be those are the owners. So in this case, it is the ordinary shareholders. So what is the value that they have? What is the value? What is the total value of the ordinary share capital?
51,000.
And they are saying that they will be writing off what? 75%, isn't it?
Percent of that, yeah.
Okay. So if they are writing off 20, so So let me come here and do other workings over here. So I'll do it in a vertical format. Okay. So we have the 2. Okay, let me come down. Maybe this one can be able to, okay, I'm not sure, but anything can happen. Let's come here and have 2 over here as the ordinary shares. Okay. So the ordinary shares, I'll do it in a vertical form. Okay. So I'll have their balance brought down, isn't it? Of 60,000. Then we take preference shares from it. Okay. So we take preference shares from it. That will be 9,000. Okay. So if they are writing the 51,000 by 75, what will be the reduction in the what? In the equity shares?
It will reduce
38,000.
to 51,000.
No, they are reduced. They have 51,000 and they are reducing it by 75%. They want to reduce their value by 75%. What are we having? Okay, 38.
38,250.
Okay, would that be a gain to the
Yes.
entity or a loss to the company?
Will be a loss
To
It will be a
who?
loss.
To who?
to the equity shareholders.
And it will be a gain to who?
The firm.
To the firm. We are doing this for the firm. So it will be a loss to the equity shareholders, and that will be a gain to what? To the firm. So we have ordinary shares. Then we have 38,250. Okay. So we come here and reduce the what? This, you can bring capital reduction up over here because they have reduced this one by 38,250. So they will now be having what? Only 25%. The entry that you pass over here is to debit the equity account because equity is having a credit balance. So if you want to reduce it, debit the equity account and credit the what? The profit or loss account if you are doing profit or loss, because that will be a gain to the entity. If a liability is reducing, that is a gain to the entity. But we are not having profit or loss account over here. What we are having as a profit or loss account is a capital reduction account. So we take that one to capital reduction account as a credit. Okay. So we are actually okay with that now. And let's see the 3.
3.
Yeah.
The ordinary shareholders have decided to inject 75 million in consideration for a new issue of equity shares issued for 50 million shares at 1.25 Ghana cedi. The remaining amount to pay off part of the 15% long-term loans if the reconstruction scheme is accepted.
Okay. So they are saying that the equity shareholders are injecting, they are bringing in additional cash of 75 million, isn't it?
Yes, sir.
Okay. So this entry will be between cash and what? The equity shares, isn't it? There's no gain, there's no loss on this one. But how much? How much are we giving? Are they giving to them in terms of equity? By how much would their equity be increasing? They are saying that to be 15 million at what? 1.25. Okay. What are we
Yeah.
having? 15 million at 1.25.
2.5.
That will give us.
This 2.5.
Okay. But how much are they bringing?
75.
It means that these shares are issued
75.
at what? The shares are issued at what? You are giving 75 for what? For 62,500. This is issuance of shares. So it means that the shares are issued at what?
Discount.
No, please.
The premium.
Yeah, the shares are issued at a premium.
That's a premium.
Okay, so the shares are issued at a premium. So we have cash or bank as the third one here. So let's come here, cash and bank. Please don't write the overdraft against this one. Okay, if the overdraft should be relating to this cash and bank, it will be what? It will be written off. So you have the overdraft over there. It means that that particular overdraft is arising from a different bank, and the cash and the bank also is from a different bank. Okay, so don't write the overdraft over unless the question is telling you that the overdraft is to be repaid. Then that is when you write the overdraft against any cash that you are having. Okay, so we come to the balance brought down for this one. What is the balance on the what? On the cash and bank?
65,000.
65.
55,000.
So we have 65,000. Then we have issue of equity shares, isn't it? The bank will be receiving what? The entity will be receiving 75,000 from it, isn't it? Okay.
Yeah.
We come here and now have share premium under this particular one. So we have a share premium here. And that will be, what will be the difference?
12,500.
So that will be 12,500. So the entry that we have passed is debit cash or bank, credit the equity by 62,500 and credit share premium. Okay. They say that the remaining amount will be used towards. The remaining amount will be used to.
Pay
The
off
remaining,
part.
okay. The remaining amount is the 12,500. It means that we are going to be using the 12,500 to pay part of the what? Part of the 15% long-term loan. So we are going to be using the part of this one. So what it means is that we are going to be crediting our equity. We are going to be crediting our equity with 62,500, but the entity will be receiving 75,000 from the equity shareholders. It means that the equity shareholders are bringing 12,500 in excess. It means that we are giving the shares to them at premium. So we have the premium account. But what will happen over here is that we are going to be paying the 15%. Okay. What the question is trying to tell is that the entity will issue the shares over there, and 12,500 of the proceeds will be used to pay off what? Of that particular loan. So we'll be having 12,500 over here as a payment of the loan. What will happen to the long-term loan balance? The long-term
It will
loan balance,
reduce.
it will reduce by
It will reduce.
12,500.
Mm.
Okay. There is no issue of gain or loss there. So capital reduction will not come in. Capital reduction is basically like what? Profit or loss accounts. Okay, let's take the 4 now.
Please, I want to add the cash that we have debited at the capital reduction. I thought since it was issue of shares,
We haven't done anything in the capital reduction account relating to the cash.
okay, I was seeing cash of 62,500.
That is ordinary shares, not capital reduction account.
Oh, okay.
Yeah.
Sir,
Yes,
so
sir.
so the balance, the 12,500, it must be where?
The balance of
12,500. The difference between 75 million
okay,
and 62,500.
okay.
I wanted to know the reason why you passed it as share premium.
Okay. You want to know the reason why I've passed it as share premium?
Yes, sir.
Okay. So if a price of an item is 10 cedis and you are paying 12 cedis, what is the meaning? The normal price of the item is 10 cedis and you are paying 12 cedis. Okay, let's forget about the 12 cedis. The price of the item is what? Is 10 cedis and you are paying 8 cedis. What is happening there?
I think there's an element of discount there.
You are enjoying discount, isn't it?
Please.
Okay. Right now the price is 10 cedis and you are paying 12 cedis. You are paying excess of what? Two Ghana cedis, isn't it?
Yes, please.
That excess is called premium. The person is selling the thing to you at a premium, or the person is charging a premium price for the item.
Thank you,
So
sir.
the shareholders are paying more than what they are receiving. The shares has been given to them at what? At an excess amount, and the excess amount is called share premium. So can I move on now?
Yes, sir.
Okay. So seniors take the
4.
yeah.
4. The preference share dividends and debenture interest are 3 years in arrears, but have been wrongly credited to the trade receivables. The
Okay.
preference and debenture holders are willing to convert all their dividends in arrears to ordinary share of 1.25 each if the reconstruction scheme is accepted.
Okay. Don't worry about what the clause that they'll be adding that if the reconstruction is accepted. We are implementing the thing, so it means that it has been accepted already. Okay. So
Definitely.
don't go and be looking for a footnote that will confirm that the reconstruction is what is accepted. No. As far as the question is asking to prepare statement of financial position immediately after the reconstruction, the assumption is that the reconstruction is accepted. That is why we are implementing it. So forget about if it is accepted. It has been accepted. Okay. So let's come to this, please. We have to calculate what the preference dividend and the debenture interest now. They say they are in 3 years in arrears. So we have to know what is the interest every year and multiply by the figure there. So let's go to the preference shares. We find the interest, the dividends on them, and we also do it for. So let me bring those ones somewhere. Okay. So let me come here and have another workings here. So I have preference dividends. Okay. So I have preference dividends. Please, the preference dividends is calculated as what? How do we calculate preference dividends? %15 cumulative what? Preference dividends. We see that preference shares are also treated as what? As liability, or they are just like debt instrument. So the 15% added to them is just what? The interest. So you pay that particular amount on the value that you are taking from them. It's just like how you calculate interest. So the rate attached to the preference shares multiplied by the preference share value, that will give you the dividend. It's just like how you calculate interest. The interest on the loan multiplied by the loan amount. So the preference shares is just like what? A loan. Preference shareholders are not owners. So the preference dividend will be 0.15 multiplied by 9,000. The preference shares is 15%. So every year we are paying dividends of 15% on the amount. So 0.15 multiplied by 9,000. That is the preference dividend for every year. So we have 0.15 multiplied by 9,000. What are we having every year?
Three,
1,350.
That will give us
1,350 every year.
Yeah.
okay, 1,350. But they said these are 3 years in what?
Arrears.
So we multiply by what?
3.
Okay. So we multiply by 3. What are we having?
4050.
Okay. So that will give us 4050. Let's come to the debenture interest. Okay. Let's come to the debenture interest. The debenture interest will be 12%. 12% multiplied by 12% multiplied by what?
150,000.
150,000.
Okay. 150,000. Okay. So 150,000. What are we having?
18,000 per year.
18,000.
18,000 per year. So 3 years will be multiplied by 3. What are we having?
54,000.
54.
So we have 54,000. Okay. This one means that we have to go and do some adjustment to our receivables again. Okay. But this is what you are going to be looking at right now. Okay. So this is what we are going to be looking at right now. Okay. What if the question added interest on preference dividends? The interest on preference dividends is just like, what if the question added interest on preference dividends? No. What will it be? Interest on dividend itself is a what? It's an interest. So what should it be? Interest on preference dividend again. Okay. So if you should come with that particular one. So let's come to this figure. Okay. So this is the entries that we are going to be passing. Okay. Someone can assume that the 160 over here, okay, the 160 over here, which is the trade and other receivables, is actually what? Is actually for the receivables that we have over here. It's actually for the receivables that we have over here. And that is after taking the interest and those ones out of it. Okay, so it means that the interest portion relating to this is the net. The 160 over here is the net. Okay, so we are doing it for this particular receivables. Is the net. So someone can come and add the interest and that one first before the person will find what? Will find the reduction in the what? In the receivables. Okay, but what we are going to be doing is that we are giving these receivables relating to the net figure over here. How did we get a net figure? They are saying that this amount has been taken away from the receivables. What it means is that the actual receivables should have been 4050, okay, plus 81,000. How that is okay?
It was 54.
No, the interest and dividend for the 3 years has been taken away, has been wrongly credited to receivables. Credited to receivable means that it has been taken away. So we go and add back. Okay, so it means that the actual receivable that should be in the statement of financial position over here should be
Please,
how
the
much?
debenture interest is 54,000, not
It's
80.
54. Oh, sorry. So no, 18 multiplied by 3 is 54. Okay.
54, yes, sir.
So that will be 54,000. So the actual debenture, the actual receivables that we're supposed to have over there should be 194,000. Okay. Plus 4050 plus 54,000. That should be the actual receivables. But they have taken the interest and those ones from it. So someone can say that this is a total receivables. Okay, this is a total receivables, and they have given this amount to you as a net, as the money that you are going to be receiving. So what will happen is that we have to go back and adjust the increment in the receivables. Okay, if you have done this, fine. Okay, if you are also saying that the 160 over here is relating to this one, the meaning is that these people are going to be paying their amount. So what you have to do now is you can go here and add this figure to the receivables that you have in your financial statement. This will be 40 plus the 54,000. Okay, but the best assumption over here should be the receivables that we are having at the end of the year is 160,000. Okay, the receivables that we are having at the end of the year should be 160,000. So before we fair value or we look for the reduction in the receivables, it means that we have to gross the receivables before we do the reduction. So let's gross the receivables and go and adjust that particular figure there. Okay, let's gross the receivables and go and adjust that particular figure there. So what will be the increase to the receivables? 4050 plus 54,000. I'm having 58050. Okay. But the receivables is what? Is 160 over there. So it means that the receivable, there will be a further reduction of 58,505. Okay. So let's add it so that I can pass the entry for that one. Then it will be very simple. Okay. If you add the 58 to the 194, what are you having?
Yeah. Hello, sis.
Yes, please.
Yeah, please. Please, I want to find out. Because they wrongly credited the receivable, that's why we are crossing it out.
Yes, please. Any further question? What are we
Hello,
about?
sir.
Yes, please.
The question that my brother asked that because the question asked it was wrongly credited in the
Yes,
receivable account.
yes,
So
please.
if I may ask, is it the initial receivable like the 194 that it was wrongly credited and increase
No.
it?
After crediting, that is where they have the 194,000.
Okay.
So what was the original receivables? That will be the issue now. Okay.
Okay.
So what will be the original receivables?
So 252,050.
Okay. So that will be 252. Okay. So find the difference now.
So the difference between the which
Difference
one?
between the
160
160.
and that one. That should be the actual receivables. And we are going to be receiving only 160 out of it.
Okay.
92,050.
92.
050.
Okay. So the actual reduction in the receivable should be 92,050, isn't it? 92,050, isn't it?
Yes, sir.
But how much was taken here? We have taken only 34,000. So what should be the increment? Okay, so what I'll do is that I will take these receivables off. Then we go and pass the entry for that one. Then we come back here. So our receivables should be, okay, let me take this one off too. So I'll be adding the 58050. I'm sure that is a figure. The addition of the two.
Yes.
Okay.
Yes, please.
So this is supposed to be our total receivables. Then what we do over here is that since we are removing the receivables over there, we now come here and say other payables. So we now pass the entry for this one as other payables. So we are removing and we are bringing, this should be treated as a liability. So we have 58050. So we are removing it from the receivables and now treating it as a liability. Let's now find the difference between our receivables. The receivables should have been 194 plus that one. That is the original receivables. If the interest and the dividend has not been credited, receivable is an asset. If you are crediting an asset, you are reducing the asset. So what should have been the original receivable? Should have been 194 plus 58050. Okay, and we are receiving only 160 of this. So what would be the difference? The difference would be the 92050. Okay. Or someone can bring the additional 58 to the capital reduction account now, because that has actually reduced the receivable. So it means that that portion of the receivable that has been reduced by the interest and dividends will not also be received, because in total we are receiving only 160,000. So that portion that we have reduced will not also be received. So that should also be treated as well as a bad debt. Or to be at the safer side, just find your original receivables and treat the liability now as liability. We are removing the other payables, which is the interest and the dividend from the receivables now to a liability side. So the receivable should gross it. Then you now find the amount that you are going to be receiving from the receivables. That is okay. Okay. So what do we do? They say they are going to be converting that to what? Those people, they are willing to convert the value to what? To equity
To
shares.
equity.
Okay.
Yeah. Yeah.
So what will be the movement? We will now change the liability to equity, isn't it?
Yeah.
Yes.
Okay. Please, forget about the 125. What they are saying is that the amount that the entity will be, the entity will be giving them a value of this one. But to be a number of shares issued at 1.25, that will give them this one. So if you want to find your number of shares, you just divide by 0.25. It doesn't change the fact that if you're owing me 5,000, I'll be giving you 5,000. But I want to give you shares that is valued at 5 cedi. It doesn't change the fact that I'll be giving you more than 5,000. No, I'll just pay you the 5,000. So the shares I'll be giving to them will be up to the value of their what? Their owings or their interest or their dividends. So the difference over here will be, please, this is in their books. Sometimes the dividends will be treated as a what? As an expense. That is when there is no recourse for the dividends and there were the interest in the entity's book. It means that has been waived away. It has been forgotten. It is interest that has been what? That has been forgotten. So it's just like you are owing me and say, oh, don't pay. Now I'm asking you to pay. That will now, you paying now will be an expense to you. So there can be a situation where the dividend will be treated as an expense in the capital reduction account. That will only happen when there is no recourse in the books of the entity as what? As dividend. It means that the initial dividend has been treated as a gain because the people are asking them not to pay. Now they are asking you to pay. It means that that particular gain must be reversed. But in this particular situation, the dividend is in the books of the entity. So the entry will be between equity and the other payables that we brought to the books now. Okay, so we have the interest. Okay, we can have interest and dividend owings as one item. Interest and dividend owings. If you like, you can separate it, and that will be increasing our equity now, and our other payables will now be reducing. So we now take the other payables over here. It means that we are transferring it to equity. We are moving it from this side to what? To equity. Okay.
Yes, sir.
Yes, ma'am.
Please, so that means the receivables will no longer be 34,000, right?
The impairment in the receivables.
No, the original receivables that we calculated to
The
be
ori-
34.
that is not the original. That is a reduction in the receivables. The original receivable is
So,
160,000, but the 34 is a
okay,
reduction.
okay. And also, if you can throw more light on the payables, the 58 and 50. I don't know how you got that figure.
The 58 and what?
The 58, 5,850.
Okay, I want to, I want to, I want to what? I want to make a fun of the throw more light, but you might be my mom. So if you should be my age mate there, then I will say I don't have light. But since you are my mom, uh, I will not say anything. Okay. So
Thank you.
all right.
You have
So
already said it too.
so this one, so you are okay with the preference dividend, which is the 1350 multiplied by 3, isn't it?
Hey,
Yes.
Lionel.
Okay. Then that will give us 4050 for 3 years, isn't it? Mommy, are you with me?
Yes.
Okay. So the debenture interest, so you are okay, 18,000, isn't it?
Yes, please.
If we multiply by 3, that will give us 54,000. Okay. If we put the two together, what are we having? Yeah, if we put the two together.
Okay.
Okay. So they say that the two has been credited to the receivables. It means that it has been removed from the receivable.
Okay,
So
okay.
we go and add back. I hope it's okay now.
Okay. Yes, please. Thank
Okay.
you.
Okay. Okay. All right. So I hope that is fine now. We can move on. Okay. They can still bring a question on capital reduction. Okay. Anything is possible. And they can still bring question on business valuation. Anything is possible. And it can also be external reconstruction. But external reconstruction is not anything. I'll bring a question so that we come maybe another time and so. Okay. There's no problem with that. Question the 5.
Okay. Should I go ahead?
Yes, please. Yes, please.
Yeah. Footnote 5. 20% of the carrying value of the preference shares and debentures are to be written off if the capital reconstruction scheme is to be implemented. The debenture holders are also willing to convert 100 million of their value to ordinary share of 1.25 each. If
Are we together? Oh no, let's take the 5 already. Let's deal with it one by one. So
okay, okay.
20% of the carrying value of the preference shares and debentures are to be written off if the capital reduction is accepted. The debenture holders are
Yeah.
willing to convert 100 million of their value to ordinary shares of 1.25. The 1.25 means that all ordinary shares are now going to be valued at what? 1.25. That's why they are giving you 1.25. In the reconstructed firm, equity shares will now be valued at 1.25. Okay. So they are saying that 20% of the preference shares, okay,
Mm-hmm.
okay, 20% of the carrying value of the preference shares and the debentures are to be written off if the capital reduction is to be implemented. It means that they are willing to reduce their what? Their owings or their holdings now by what? By 20%, isn't it?
20%.
So it
Yeah.
means
Yes.
that in the reconstructed firm, we are going to be paying them 80% of the amount that we are owing them. These are all liabilities.
Yeah.
If a liability is reducing, what is happening?
Again.
It's a
Again.
gain. So we go there and
So
do,
again,
we find the 20% of their respective amounts. So let's come to so we come to preference shares over here. So we find 20% of their 9,000. I'm sure that is 9,000. So
Yes, sir.
0.2 multiplied by 9,000. What would be the gain?
1,008.
Okay. The benches will give us what? 0.2 multiplied by, what is your total figure?
30,000.
30,000. So that will give us how much? 6,000. Oh no, the benches is 150. 12% debenture is 150. So that is 150,000. Okay, so the reduction will give us 130.
30,000.
30,000 rather. Okay. So what is the entry that we are going to be passing? We are going to be reducing. So in the new firm now, in the reconstructed firm now, preference shares will now reduce by 1,800, isn't it? Will now be only 80%. Okay. This will now reduce by what? 30,000. It will now be 120,000. Is that correct? Okay. How that is cool.
it's cool, sir.
Okay. And the question is saying that the debenture holders are willing to what? Are willing to convert 100 million of their value to ordinary shares. So it means that 100 million of the debentures will now be converted to what? To equity shares. How do we pass the entry? $100 million people that are having 100 million as debenture holders, would they be debenture holders in the reconstructed firm, or they will now be equity shareholders?
So there'll be equity shareholders.
Equity shareholders.
So it means that we remove the 100,000 from here, isn't it?
Yes, sir.
And send it to equity. So we have debenture holders that are converting to equity shareholders. So this is why I said that you have to do workings for the equity. Most of the times, the items that will be affected more is the equity and sometimes the bank. Okay, so we can actually move from that area to other issues now. The 6.
Six,
Yeah.
if the reconstruction scheme is to be implemented, trade payables and 15% long-term loans are willing. Let me take it again. Trade payables and 15% long-term loans are willing to write off 9 million and 80 million and 50 million of their values respectively. I don't know
Okay.
whether there's
Oh, don't worry. Don't worry. Trade payables are writing off how much?
trade payables
90 million, isn't it?
are writing off
Yes, sir.
90.
Okay. So they are writing off 90. It means that in the reconstructed
90.
firm, the trade payables will no longer be the value that we have over here. It will not be the 140 again, isn't it?
Yes,
Okay.
Yes,
please.
sir.
It will now be how much?
140 minus 90.
Okay. And that will be
90.
50, isn't it?
50.
Okay. So it means that they have reduced their what? They have reduced. It's just like, let's take all these things that we are revaluing all of them. It was 140. We are now revaluing to what? To 50. It means that there's a revaluation gain of what? 90. This is a liability. If the liability is reducing, that is a gain. Okay. So we count to the trade payables now and reduce it by 90, and the corresponding entry will be the what? So we
Capital
have
reduction.
we have trade payables here.
Yeah, it's 140 and they're writing off
90.
They are
90%.
writing it off.
90.
So
Yes.
remaining will be 50.
So meaning the gain will be 50.
No.
No.
Writing off means that you are throwing the 90 away and you are receiving only you are receiving
50.
50. But if they say they are writing down to, it means that they are now saying that it should be give me 90 million instead of what 140 million. But they are writing off. It means that they are saying that okay, you reduce our balance by 90. So the gain is 90.
Okay.
Okay.
Get it.
So
Sir.
the trade
Yeah.
payables will now reduce by 90. Okay. The 15% loan note will also reduce by what?
50.
By
50,000.
Okay. So that will also go to the capital what? Reduction.
So why do we send it to the credit side of capital reduction?
If you are owing me, I say don't pay. Would that be a cost to you?
It will not be a cost to me.
You are owing me 30
Yeah.
billion. You are owing me 30 billion. And I ask you to write off 20 billion. Are you going to be searching for the 20 billion to pay me, or you say that okay, you have saved what 20 billion out of the amount that you are owing me? That would be a gain to you. Instead of you paying me 30 billion, you are now paying 10. It means that you are what? You are saving what? The 20 billion. Okay. Okay. So very soon you will be owing me that amount of money. Okay. So that would be a gain to them. Or just take it like this is a liability. So we are revaluing everything. So we are revaluing the liability too. The liability was first what? 140. Now you are saying that it's 50. The liability has reduced by 90. How do you pass the entry? You debit the liability. Okay, you are reducing the liability. Then you credit revaluation surplus because you are revaluing the liability. Liability is what? It's a cost. So the cost reducing, that is what? That is a gain to you. Okay. So this is the entry that we pass for this one. Okay. We are left with one thing. Okay. Or even two things. Okay. The retained earnings and then the capital surplus. You write off the what? The retained earnings against the capital surplus. There's no problem with that. Okay. Let's come to the 7.
Hello, sir.
Yes, please.
Yes, please, I want to be clear. The 100 million debenture that has been converted to ordinary shares,
No.
would that increase our cash? Would it affect our cash
No,
position?
the movement, we have the debentures already. So we are just transferring from debenture account to what? To the equity. We are not issuing shares to them. We are not issuing new debentures. So it's just the existing debenture holders that are converting their debenture to what? To equity shares. So it's not issuing of new debentures. It will only be a cash when you are issuing new debenture.
Okay, thank you.
All right. So someone is saying, again, why not 50,000 for, again, why not 50,000 for trade payable? Please, can you explain why we charge the 12,500 from the share issue against the long term? Please, are we reading the footnotes or we are just looking at the solution? Okay, because I'm sure that if we are reading the footnotes, there is no way those questions will be coming. If the reconstruction scheme is to be implemented, trade payables and 15% long-term loans are willing to write off 30 million has been written off against this one. Write off means that you have taken that particular amount. Okay, you have erased what? That particular portion of whatever you are having. So they have written off their figure by their 140 by 90. What it means is that they have accepted to reduce it by what? By 90. So we are going to be paying them 50 now. The remaining one is the 50, which you are going to be paying. So the gain is the 90. They are saying that they are going to be forgetting or they are going to be letting go of the 90, which is write off my account by 90. It means that reduce my account by 90. That is the meaning. So the 90 is the gain. Okay. The debenture is secured by a floating charge over the assets of Kabul Limited other than investment. The current market value of the investment property is 15 million. So let's go to the investment property. What is the carrying value in the books? Investment property.
12,000.
Okay, but they are saying that it has been revalued to what?
15.
So what is
15,000.
happening there?
It's a upwards. Yeah.
So we have the investment property of this will be at the debit side. Okay, so we have investment property of
3,000.
3,000. So it means that we debit the property and credit what? Revaluation what? Surplus. But we don't have the revaluation surplus. So everything about revaluation and the profit, everything is done in the capital reduction account. So we are left with some things to bring it over here. We'll be bringing the retained earnings, isn't it?
Yes, please. Negative return earnings.
The retained earnings over there. The retained earnings over there is a loss. Okay. If it is a loss, we know that the earnings is for the shareholders, isn't it? The earnings is for the shareholders. So if it is a loss, it means that the shareholders value is going to be reducing. Okay, so the shareholders value is currently reducing by the loss over there. But they are saying that you should write that one off. So it means that you're going to be paying the full amount. Okay, let me demonstrate this one over here. So we have what? We have a business that we are running, and I have 5,000 Ghana cedis in it. Okay, and currently there is a share of a loss which is 500. It means that you have to be paying me 4,500. Okay, now we are doing reconstruction. We want to now reconstruct the company by bringing it to what? To the old days as a new entity. And we are saying that you have to write off what? The 500. We have to forget about the 500 over here. It means that you'll be paying me what? 5,000 instead of 4,500. The entity is losing. The entity is supposed to pay me 4,500. But we are saying that we are going to be forgetting about this one. So we are going to be sending the 5,000. It means that the entity will suffer the 500. The retained earnings will always be treated as a cost. Retained earnings in actual sense can be treated as an asset. Okay, look at it. Look at the impact of the retained earnings on our equity. You can see that the retained earnings is reducing what? Our equity. Can we say that?
Yes, sir.
Okay. If it is reducing our equity, Another presentation will be like we can decide to treat what the retained earnings as part of the equity, as part of the assets. Because if it is over here, it is going to be reducing the equity. So if it is here also, we can decide instead of subtracting from this one to get 55,000, we can actually bring it over here and maintain this one to be what? To be 60,000. And the 5,000 will be on the other side of the accounting, will be on the opposite side of the accounting equation. It is going to be cancellation. So the retained earnings is just like an asset, and you are writing off the asset. That will be a loss to the entity. So retained earnings will always be what? Will always be a cost, or will always be a loss to the what? To the entity. Okay. So
So,
we are
sir,
going to be,
what about if it were to be positive?
the reconstruction will not be done in the first place.
Okay. Okay.
Okay. We are doing the reconstruction because of the consistent losses. Okay.
Yeah.
So if they are making profit, they will not pay attention to any, because shareholders, they are only interested in the profit. So since the entity is making profit, even if they want to restructure, maybe there will be some parts that they are going to restructure. The company will still be like that. They will not close down a lot of things or say that they want to restructure their what. No. The reconstruction will not even be done in the first place. Okay.
Okay. All right.
So
Thank you.
we come to this place, we remove the retained earnings. So that was negative, we add 5,000. That will now be this one. What we do over here is this. You can decide to maintain a capital surplus, or you can write it to the capital reduction account. So every reserves, we are starting from zero. So there should not be any reserves. The only thing that you are going to be having should be the share capital. But if after the reconstruction, there is a gain over there, there is a gain from the reconstruction. So you can send it to what? To the what? To the new firm now, or the reconstructed firm. So you bring the capital surplus over here. Okay, the capital surplus over there is actually what? A gain. So if you are writing it off, it will be a gain to the entity. That amount should be paid to the what? It's an amount due to the equity shareholders. We want to forget about it. That will now be a gain to us. So we have the 70,000 over here as the what? As the capital surplus. Okay. Let's add all the size and see what will be the outcome of the reconstruction.
So what about the
What about, Zina, you were saying something?
bank overdraft?
Bank overdraft, no. We don't have any information about a bank overdraft, so we still send it to the what? To the reconstructed firm. Nothing has been said about it. So it means that they are not willing to what? To, you see, this reconstruction, okay, it's not something that you have to impose on what? On the other holders or other parties. It will be the shareholders that are going to be suffering because of the equity shareholders. The company is for them. So if there should be any cost, they are going to be incurring the cost. But what you have to do is that we are all human, so they will talk to other parties or other loan holders, and if they are willing, they will reduce. If they are not willing, fine. So since nothing has been given about the bank overdraft, it means that we are still going to be paying the 9,000. Okay. All right. So let's come to the other. Let's total this one and see what will be the outcome of the reconstruction. I'm doing the debit side.
Hello, sir.
Yes, bro.
Sorry, my line network was disturbing. I was asking what becomes of the overdraft, bank overdraft.
Did we have any information about overdrafts concerning?
No, please.
No. So it means that you are going to be paying the same amount. Those people are not willing to write off any amount. Okay.
Okay.
They are irate people, so they don't want to write off any amount. Okay. The reconstruction should not be something that you have to impose on other parties. It will be the owners. The company is for the owners. So whatever will happen, they have to suffer. So those that are going to be suffering more is the equity shareholders. But since you're all human, you can plead with the other holders, like preference shareholders. Okay, these things, if the thing happen, it's an investment. If you are making profit, you also get something over there. So if you can look inside for us, we can decide to reduce some of the amount. So that should not be something compulsory on them. Okay.
Okay.
So the bank overdraft, nothing has been said. It means that they are still going to be having that amount there. I'm having a debit side to be 172050.
Hello, Linus.
Yeah,
Yeah,
Hello, sir.
it's good.
Yeah.
Linus,
Yes, ma'am.
please,
Credit side.
Okay. Let's close everything, then we take the question. Okay. So
Yeah.
Credit side. I'm
yeah,
having 298050.
298.
050.
Okay, someone should
Confirm.
confirm that. Okay.
Confirm, sir.
Yeah.
So what
So
will be
the
the
difference is 26,000.
okay? The difference is 20.
6,000
Really?
on the debit. Yeah,
No,
that's
it's
the number.
126,000.
Yeah, it should be.
Hey, fine. Please.
Yeah.
126,000.
Sorry.
Okay.
126, sorry.
So you can see that we are having a gain from this reconstruction, isn't it?
Yeah.
Okay, so the gain will go to the capital surplus. So this particular gain from the reconstruction, 126,000, will be taken to capital surplus. So we have a 298,050, 298,050. Okay, so we still have the capital surplus back. Okay, this will be 70. Then we add a 126,000 again. Okay. Then the equity shares, we total it. We don't have to do much on the equity shares again. The bank also, we total it and we send it there. So once you can now,
Yeah.
yes, please.
Sorry, I want to ask. So what if you do it the other way? Is it going to be wrong? Instead of bringing the capital surplus to the credit side of the capital reduction to add, the difference that you get, you rather add it to your capital surplus, yeah, you still
Okay.
get the 126.
Yeah,
Is it?
that will not be wrong. Okay, but how will you know that the difference will be a gain? Okay, so you can do it, and this side will be higher than this side. Okay, and you don't know how to treat the loss. But you have to know that the loss, you have to go and take it from the capital surplus. If there's any loss again, then that might be a goodwill, or that might be apportionment to the ordinary shareholders again. Okay, but
I
this one,
remember we solving this question, and so I think what we did was that we use the other way around. So instead
okay,
of bringing the capital surplus 70,000 under the credit side of the capital reduction, the difference was that the credit side was higher than the debit side by 56,000, and so the 56,000 was added to the capital surplus with the 70,000, making 126,000. So if that be the case, then
that was that we
the
anticipated
total year,
that will be a gain, isn't it?
yes.
Okay, that's why we didn't bring the capital surplus again. Okay, but what if it should be a loss? Okay, what if this should be a loss and the loss is higher than the what? Let's assume that the loss is now, this side is higher than this one. This is 126,000. Okay, but we didn't bring the capital surplus. We have to know that, okay, since we are getting a loss, capital surplus will take 70,000 of this one. But if you are not fast to dictate that, it means that you'll be treating the 126,000 as a good deal or additional loss that will be taken to the ordinary shareholders. Okay. But the time that we are solving, we anticipated that it would be a gain. And we said that, okay, since it will be a gain, let's just maintain the 70 and come and add the what? Because the gain will still come to a capital surplus. So let's add the 56,000 to that one to have the 126,000. Okay. Whichever way, you will be having the same answer at the end. Okay.
Yeah. Hello, sir.
Yes, boss.
Yeah. Yeah. Before we started the question, do you remember you brought some value? You said it was liquidation, and you made us change it.
Yeah, it was a question. It was a combination of liquidation and what? And reconstruction. So they have examined the liquidation part. So instead of modifying, I've taken the liquidation issue. So I should have made those ones should be revalued amounts. Are you okay?
Okay,
I didn't see that
so
one.
I'm saying that in case they didn't they didn't say anything,
You
then we
don't
have
u-
to maintain.
you don't use the liquidation values. Liquidation is only when
So
you
I'm
want
saying
to
that
dispose. Yeah,
then we have to repeat the balance sheet amount. They're not going
exactly,
to revalue.
exactly. Liquidation is when you are selling. So since you are not selling the assets, it means that you cannot receive those values. Unless the question is saying that liquidation value should be considered as what? As a fair value of the asset. Isn't that okay?
Yes, please, I'm okay.
Okay, okay, okay. We can now make one step forward, isn't it?
Yes, sir.
Okay. Let's look at the number 2 business valuation ratio. Then we find our way around this one. Okay.
So please, did we get the ordinary share figure?
No, we didn't add. For the adding the focus, the adding you
Okay.
can add. Okay. The adjusting the footnote is the problem. So the adding them, you can just add the cash and bank and the ordinary shares to you just add and fill in the spaces by yourself.
Sir,
Yeah.
Linus,
Yes, ma'am.
please, the capital reduction, the ordinary share, that figure, it's also here. The 38,250, please, how did we get it?
38 what?
250.
How did you understand the footnotes? You are my age mate, so for you then, I can ask you any question. Now, if you are older than me by 2 years, doesn't mean that you are old. Oh. You are still my age mate. Okay, 10 years to be
Who told you that
significant.
I'm older than you 2 years, Linus?
5 years is still
Yes,
immaterial to me. 10
Can you
years is
project the
material.
statement? I want to look at it.
Okay, Auntie Vic, boss, I will do that for you. But let me
what?
adjust this one
Please, is
first.
it from the second floor? I don't know where exactly.
Is it around the corner, of course?
Where are you?
Footnotes. Not be footnotes too.
Footnote 2.
Is it a t-shirt or like a bamboo t-shirt?
To write off.
This is too big. It's big, it's big.
What are you talking about big and small things there?
Linus.
Auntie Vic, okay.
Yes, please.
They are saying that the stated capital is made up of 60 million shares at 0.085 per share and 9 million 15% preference shares of no par value. So the equity share is 60 multiplied by 0.85. What are you getting?
51.
And they are saying that they are willing to write off the share capital in case of any reconstruction, any capital reconstruction by 75%. So what will be the amount that they are going to be writing off?
I don't understand.
You don't understand the written off, or you don't understand which one?
Yeah, the part that they'll be writing off, I'm lost.
We all came to meet the English, so none of us has inverted the English. So the shareholders are willing to write off 75% of the share capital in case of any capital reconstruction. So that is the part that you don't understand. Okay.
Yeah, I think I get it now.
Are you pretending or you actually get it?
I get it now. I get it now. I get it
Okay.
now.
Okay, thank you.
Thank you.
Okay, Senior, you asked for the board. Which side of it? Someone asked for the board. Which side of the board? Okay, so I'm sure the person is not there. Please
So the ordinary share. The ordinary share. Yeah.
Okay.
Linus,
Yes, please. So
with
let's
the
let's look at this. If you have any issue again, so let's look at the solution. Or let's take like 5 minutes to resolve any issue. So look at everything. If you have any problem, then you can let us know. Resolve it, then we move on so that we don't come back again. Okay. So you can talk now.
okay, with the bank overdraft, even though they've not said anything, should you end up maybe deducting it from the cash and bank? Will you be marked down?
Marked down by who?
Maybe you are wrong or something.
Why are you subtracting?
It's an overdraft and now there's some money in the account, so taking it off. Or yes.
So yeah. So the issue is if the bank overdraft should be relating to the bank that they have the balance on, it should have been taken away before you even have those figures in the statement of financial position. So if the positive balance is relating to a bank or is relating to a bank that the entity is having the overdraft, you know that the overdraft will be taken away automatically, all things being equal. Okay. So if you have the overdraft, it means that the overdraft is on a different account in a different bank, and the positive balance is also on a different account in a different bank, or they have a special arrangement to the settlement of the overdraft. So you don't have to do anything with the overdraft unless the question is asking you that the overdraft to be repaid immediately. That means that any cash or this thing you have, you go and take it from the cash that will be coming in there.
Okay, thank you.
All right.
Hello.
Yes, boss.
Please, the debenture 100 million cedis. That is, they are like note 5. The debenture holders are willing to convert 100 million of their value to ordinary share of 1 CD, 25 CD each. So does it mean that the 100 million, they've already converted it into CDs?
The 100, that is the value of the portion that they are. The 100 million is in what? Is in Ghana cedis. Are you okay? So it means that they will just remove 100 million, not the value there is not shares. Okay. It's Ghana cedis. So why is it that particular one? It's actually Ghana cedis. So they are changing 100 million of their what? They are holding to equity shares, but the shares will be valued at what? 1.25. So how many shares will be given to them at 1.25? And that will give them what? That will give them the 100 million. So it's just 100 million. You are taking 100 million away from the amount that you are having to equity shares. So that one it's not number of shares that you have to multiply by 1.25. No. But the shares that they are giving to you, the share will be valued at 1.25. And you'll be getting the 100 million. So how many shares? The only thing that you can find over here is the number of shares. How many shares that will be issued at 1.25, and that will be giving you 100 million.
Okay.
Okay.
Thank
I hope
you.
that is cool now. Okay.
Yes.
Sir,
Yes, boss.
yeah, can you address the footnote 7 for me, please?
The debenture is secured by floating charge over the asset of Kabul Limited. We only use this one when we are doing liquidation. Okay, so the only thing that we are interested in over here is the market value of the investment property. Okay, so if you are doing liquidation, you see that liquidation means that you close down the entity, dispose of the asset, and settle the people that you have. So the settlement is going to be in order. The first one will be a fixed charge against any asset that you are disposing. So the second one will be the liquidation expenses. We have the preferential ones. Then you count to the floating one. So this particular one will be relevant if you are doing liquidation. So it's not going to be affecting our capital reduction. The only thing that we need over there is the market value of the investment property there.
Okay. Thank you.
Thank you.
Hello, sir.
Yes, ma'am.
Please, the cash and bank.
Yes, please.
We brought this the 70, the note 2,
Yeah.
note 3 rather, the 75 million injection,
Yes, ma'am.
which has been the 50 million shares were issued as equity shares.
Yeah.
But
But
we
they are
kept the
bringing in
75.
75 million. Yeah.
Yes.
Yeah.
So 50 million by the 1.2 give her the 62,500
Yes, please.
as equity.
Yes, please. The
And
difference
then
is share premium.
then we sent the difference of 12,500 to the cash at bank, deducting it from.
No. Let me take that one again. So the entity, the shareholders are bringing what? They are bringing 75 million, isn't it?
Yes.
So they are bringing in 75 million as cash, isn't it? Okay. But the cash,
Yes.
the equity will be increasing by only 50 multiplied by. Do you know why? Do you know why we are multiplying the equity by this one? Because they are changing all the equity value now to 1.5. So the only thing that
Yes.
will increase the equity should be valued at 1.5, 1.2.
1.5.
So that will give us the entry for this one will be debit, cash, or bank. I hope that is okay for you.
Yes.
75 million. Then we credit what? Equity by 62.5, isn't it? The
Yes.
difference will be credit share premium. So we have done share premium, which will be 12.5. Okay. And the remaining
Because
amount,
I'm seeing.
okay, let's take the other part. And the remaining amount to pay off part of the 15% long-term loan if the capital reduction scheme is accepted. What they are trying to say is the difference, this one over here, the remaining amount, the equity will be increasing by 62.
Yes, 62.
The
Yes.
remaining amount will be 12.5.
Yes.
Okay. The question is just telling you that the entity, the shareholders will what? The shareholders will bring 75 million and 12.5 out of that will be used to pay the long-term loan. So we are having 75 in cash, but we'll still be paying through the cash again. So that's why we are using the what? The 12.5. As
okay.
After receiving the money, we still pay the long-term what? Loans. 12.5 out of that.
Okay. So we need to open a share premium account.
Yeah. So I have share premium accounts. I have share premium under the equity there. So let me show you that one. Okay. So it's a very simple question with very simple footnotes. But
Yeah.
it's something. Okay. So let's come here. So you can see that I have share premium over here.
Oh, okay. Okay.
I have share premium over here. All right.
Okay. Thank you very much.
You're welcome. Okay. So we can now make a progress to the.
Hello, sir.
Yes, boss.
Yes. So, still on the same issue. Does it mean that the 12.5, I don't still get that portion. Once we are going to use that same amount to pay off the 15% loan, and we still have it in the share premium account.
You are not going to be
Can you
using.
throw
You are
more
not
light?
going to be using share premium to pay. You are using cash to pay. Okay. You are using cash to pay, not share premium. You are not using share premium to pay. You are using cash to pay. Okay. So the movement will be cash. You are going to be paying cash to the people, not share premium. Okay. You are not going to be using share premium. Assuming you are not going to be paying anybody, the entries will be debit cash of 75 million and you credit equity and credit share premium. Okay. Now they are saying that you are going to be using part of the 75 million that you have received to pay. It is a cash that is going to be reducing and the liability that will be reducing. Share premium will not do anything.
Thank you.
So would we still have the share premium there or we'll cancel it out?
The share premium will be there. The payment will be between cash and what? And the loan. So you debit the loan and credit cash. That is going to be resulting on only two what? Two accounts. It's going to be affecting only two accounts. Cash will be reducing by 12.5. The loan will be reducing by 12.5. If you are reducing the share premium now, what will be the corresponding entry? Share premium will be there. Okay, but the cash that you are receiving, you use the cash to what? To pay somebody, and the cash will be the one that will be reducing, not the share premium. How that is cool.
Yes, I'm up there now.
Okay. So let's make a progress. Okay. For this particular one, a lot of things will come, but we will manage. Okay. Let's see this particular one. Yeah, let's see the question number 2. Auntie Vic,
Yes, please.
help us.
Question 2. Okay, question 2. The directors of Imole PLC are confident that their troubled company could be revived if
Auntie Vic, are you there?
Please, I'm here. Sorry for the distraction. The directors of Imole PLC, Imole, are confident that their troubled company could be revived if further funds were to be invested. The directors estimated that raising new capital for additional investment in plants will produce an increase in profits and therefore are considering restructuring its financial structure. Below is its latest statement of financial position.
Okay, so what do we do? Before you even start tackling the question, what do we do? Auntie Vic, what are we going to be doing?
As they are considering restructuring, so you'll be thinking of capital reduction accounts.
Go to the requirements. Okay, it might be either liquidation or capital restructuring. Okay, so this will be a statement of financial position immediately after the scheme. So the scheme can sometimes be either to what? If the company is not doing well, shareholders will be considering either to close down or revive the company and move forward. Okay, but this particular one, there is no issue about what? There's no issue about liquidation. Everything is about reconstruction. Are you okay? So let's come to this one. What we do, we put our financial statement over there. So you can do it the way they have presented this one to you. Liability first, asset second. Or you can have asset first, liability at the other one. So let's come there and see what will happen. So let me have. Okay.
What's that? Sorry. Okay. That's it.
Okay. So we have statement of financial position. As okay, or immediately after the implementation of the scheme.
The
So we have,
reconstruction.
okay, so we have the assets. So let me just say immediately after the implementation of the scheme. Okay, so we have the assets here. We have our non-current assets. Okay. So this one, I know that this question will be bringing a lot of issues, but we try our best. Okay, property, plant, and equipment. What are we having?
404.
404.
Let's see what is happening on the
Okay.
question.
So we have the development expenditure, which is net. This is what? This is An intangible asset. If nothing has been said about it, you write it off. Okay. So let's come to that figure will give us 88. Then we have current assets. So that will give us 88. You can leave a space for the current assets, like 3 space before the current assets. So the current assets, what are we having? That is
It's a line
216.
item.
Okay.
Mm.
So we have 216 as the figure. We now move on to equity and liabilities. Equity and liabilities. So equity and liability, you have your equity here. Okay. And you always have your share capital. So the share capital mostly we do workings. So let's go to the next item. We have 10% cumulative preference shares. 10% cumulative preference shares. That is how much. So that one, there might not be enough
80.
changes
Mm.
to that one.
Mm.
So that will be
Okay.
80. So we have
80.
retained earnings. Okay, this will
Mm.
always be
Mm.
written off, but you can bring it and subtract again. So that will be negative what?
248.
Okay, 248. Then we have non-current liabilities, like 2 spaces. You have non-current liabilities. How much are we going to be? What are the items there?
15% debenture.
So we have 15% debenture. How much is it?
200.
200. What again do we have?
Current liabilities.
Okay, so you can, another things might be coming there. So you have your current liabilities here. Okay. What are the items under the current liabilities?
Trade payables.
Okay, so we have the trade payables. How much is it?
188.
188. Do you have overdrafts?
Yeah. Bank OD. 100.
The bank overdrafts of 100.
Director's loan.
Director's loan,
68.
68. Okay, so we have to do our capital reduction account here. Capital reduction account here. Then we now start taking the footnotes one by one. Okay, if you prepare the capital reduction in a vertical format, no problem. But what you have to do is that you can mix it. Expenditure, income, expenditure, income, expenditure, income, and move on. Okay, and that is what mostly they call the maximum loss. If you are doing capital, if you are doing liquidation, the capital reduction account in a vertical form is the maximum loss. Okay, so let's take the footnotes. Auntie Vic, are you with us now?
Yes, please.
Okay.
I
Okay.
know. Please,
Yes, ma'am.
sorry to interrupt. As we were doing, I was trying to add up the first question. And I realized that the equity and liability side as it's more than the asset side with a difference of 12,500.
12,500. Do you have share premium
Yes,
in your books?
yes, I have share premium there.
Have you taken the
At the
2,500 from the cash and bank?
Yeah, I took it from the cash and bank.
So you have
At,
65,000 here
yes,
plus
65.
75,000
Yes,
minus 12,500.
plus 75,000.
65, 75, 12,500. What are you having?
So
127,500.
What figure do you have?
okay, the issue of shares, I wrote 62,500 instead of the 75,000.
And subtracted as 12,500 again.
Yes.
That's double counting.
Okay. Why are you even interested in the balancing?
I wanted
Hello.
but the issue of shares, you said it was 50 million times the 1.25, so it was 62,500.
And they are giving 75 million to the entity. So the shares we are giving to them is 62,500, but they are paying 75 million. So the company will be
Okay.
receiving 75 million from the issue. So the shares are issued at a premium.
Oh, okay. Okay. I understand now. Thank you.
Is that the anti-Doris that I know?
Yes.
Yes, is the one.
Your voice deceived me. If not, I should have given you punchlines. That's how we will do it next time. Okay, let's move on
Thank
to
you.
Antivic, let's move on.
Okay. The following scheme has been proposed. A. All retained earnings and capital reserves are to be eliminated.
So let's treat that one first. So the retained earnings will always be negative. So what do? We go to our capital reduction account and write off the retained earnings, isn't it? Okay. Please, if you cannot adjust some of the focus on the one that you can adjust and move on. Okay. So we have the retained earnings to be 248, isn't it? So we go here and take the 248 from this one. So we are done. There's no capital reserves. So no entry will be for that particular one. Let's come here.
B. Imole's directors have agreed with the National Development Bank to allow the entity to obtain a 3-year term loan facility worth 200 million cedis at a subsidized interest rate of 14% on the condition that the company stays in business over the next 5 years. The loan is repayable at the end of 3 years, whilst interest is payable annually in arrears. Without such arrangement, Imole would be charged an annual interest rate of 30%. The loan will only be available if a successful reorganization is concluded. 60% of the total proceeds is to be used to buy new production machine.
Okay. Okay. So let's come here. Auntie Victoria. I don't know whether we can remember that we were solving one question on the government grants. And we are saying that the government can give a loan, which will be including a grant.
Yes, please.
And I said that for you to do that, you have to find the debt component and the difference. You just account for it like a convertible instrument. Part of it is what? Is debt, part of it will be the loan. So you can see that this loan, they are taking it from National Development Bank. If this should be from a commercial bank, what should be the interest rate that they'll be charging?
30%.
Okay. So it means that there is a portion of what they are giving this thing to you for a reason. This is a National Development Bank. So it means that they are giving a grant. They are giving some form of assistance included in the loan. So what we have to do is that we have to separate the loan portion and also the assistance portion. Okay. The separation is very simple. It is that it just accounted for like what? Like equity and debt instruments when you come to convertible instruments. So what you have to ask yourself is that, assuming you are entering into a transaction with a bank that is not a National Development Bank or a bank that will carry or where we are going to be carrying out this transaction under normal commercial terms, how much should have been given to you as a loan at 30%? Let's look at this question. Very interesting. They are saying that at a subsidized rate on the condition that the company stays in business over the what?
Over the next 5 years.
Okay.
5 years.
So you can see that they are giving them a condition over here This condition should actually tell you that this is given on what? There's a grant over here. So they are giving you a condition over there. So if you are going to be staying in the business for some number of years, we give you a loan of this amount plus assistance of this amount. You can only get assistance if you are going to be staying in the business for what? For 5 years. How do we separate the loan? And how do we separate the assistance or the grants? Okay, the loan is the debt component. It is the loan that you are going to be paying the what? The interest on every year. It is a loan that you are going to be paying at the end of the what? Of the period. So you just find the present value of that particular cash flows using the what? The interest rate of a similar instrument without such arrangements. So if you are going into a transaction with a different bank, which is not a national development bank, what should have been the amount that you are going to be what? You are going to be receiving under 30%. So we just find the present value of this one and move forward. Okay. So this is how we do the loan component. So you separate the loan component from the debt component. How do we separate that? A very simple one. So let's come to, let me see if this place can take all of them, maybe. So I'll have workings 2, which will be the loan. I will split the loan. So I'll have the loan components and also the debt components. Okay, so the loan component, we have the years, which will be the present value. We have your cash flow. We have a discount factor of a similar arrangement without this particular condition attached. Then you have the present value over here. So you have the interest. You just present value the cash flows, like how we do it under convertible instruments. So you have your interest. You are going to be paying interest for what? 3 years. And the interest will be how much every year? What will be the interest that the entity will be paying to the bank every year? 14% on what?
200 million.
So how much are we getting?
28.
28,000.
So we pay this for 3 years, isn't it?
No.
So that made it annuity. At the end of the 3rd year, you pay the money back to us, to the bank. So let's calculate our annuity factor 30% for 3 years and discount factor at the end of the 3rd year. The discount factor 1 minus into bracket 1.3 exponent negative 3 divided by 0.3. What are you having? 1 over 1.3 exponent
816.
Okay, 816. And the last one give us what?
0.455.
0.455. Okay, so if you multiply, what are we having?
50.85. First one.
Okay, 50.85 for the first one.
The second is 91.
91. Okay. So if you put the two together, what are we having?
141.85.
141.85. Okay. So this is
the first one is 50.85.
50.
Yes.
Okay.
Yeah, 50.
Okay. So this is the loan part. So what will be the grant part? So the loan that we are receiving is 141. So the grants will give us what? The difference of this one against. So we are receiving 200 in all. So what portion of this is for the assistance? 58.15. So that will give you a total of 200. Okay. This particular assistance is given to you on the condition that you stay in the operation for what? For 5 years. So you are now starting. You are now going to be starting with a new firm. So the grant should be treated as a deferred what? Deferred income. Okay. So this is the entry that you pass. They are giving you 200 million in all. So you'll be debiting your cash of 200 million or cash or bank. Then you'll be crediting grant income or deferred income. whatever, however you want to call it, with a 58.15, then you credit loan with what? 141.85. So let's go and pass the entry for the money that we have received. Okay. So let's go and pass the entry for the money that we have received. Okay. Let's come here. So we now have a loan here. We now have loan here. Loan was not in the question, so we now have loan. That will give us 41.85. The same time we'll be having deferred income relating to the grant. Okay, so that will give us 58.15. So we have increased the liability by 200. We go to current assets. Please don't say that we have bank overdraft. So you have to know. You read the question till they are saying that the bank overdraft should be repaid or should be paid immediately. Then you come and subtract the bank overdraft from the 200. Okay. So this is the first entry relating to the money that we have received. But the question has added something to the money that has been received. Okay. That is the first entry for the money that we have received. It should have been cash and a loan. But loan has been split against assistance and also what the loan itself. Okay, let's come to the loan will be the loan will only be available if a successful reorganization is concluded. That is okay. It has been concluded already. 60% of the total process is to be used to buy new production machine. 60% of the total process. How much is the total process?
200.
Okay. Is what? 60% of the total process. How much are we getting?
So 120.
That will be 120. So 120 of the amount received will be used to pay what? Used to purchase what? Assets, isn't it?
Yes, sir.
So it means our PP over here will be increasing by 120 and our cash will be reducing by 120. Do you agree?
Yes, sir.
Okay, so we are going to be using the money to pay. So the 120, the 200 that we receive, we use the 120 to buy assets. So it means that the only money that will be left in the bank account will be 80. So after doing that entry, then you now debit PP and now credit what? Cash or bank. Okay. We are done with that particular one now. Okay. We are done with that particular one now.
Hello, sir.
Yes, ma'am.
Please, the discount factor for the 30% where for the year 3, the 0.455, did we use the annuity formula?
No,
If that is what we
if
used,
it is one payment, if you are just paying one amount, we don't use annuity. We use annuity when you are paying the same amount every year. You are paying 200 at the end of the 3rd year. That is not an amount that is not an equal amount that you are paying every year. We use annuity for only payment of equal amount.
okay.
That's how we use the annuity for the 28. You pay the interest for 3 years. So that will be 28 every year for 3 years. But if you don't understand that one, you can do it 1 year, 1 year. 1, 28, 2, 28, 3, 28 plus 200. Okay. But we don't have
Okay,
time.
because
So
the discount factor of 0.455, no.
that
The
is
formula,
1 over 1 plus r exponent n.
okay, thank you.
Okay. Auntie Vic. Okay. Don't try to understand everything over here because this question, I know that whenever I try solving it, there's always a problem. Okay, because it's an issue on its own. Okay. But everything will be fine. Let's move on.
See,
Yeah.
and directors of Imole have also proposed to acquire another plant facility on lease. They intend to lease the facility for a non-cancellable term of 5 years with annual installments of 10 million cedis, with the first payment starting in 1 year's time. Imole's incremental borrowing rate is 28%.
Which standard is this?
IFRS is 10.
Okay. So what do we do? You should recognize right of use and lease liability at the date of what? The inception, isn't it?
Yes, sir.
Okay. So we just go and do this one. Okay, so this is how they have been setting the specialized transaction question first, where they will put standards in it. But now they say they are moving from that one, but anything can still happen. So let's come to this particular one. So we have to recognize lease liability, that is leases. Okay, so you do the lease liability over there. Okay, so you do your lease liability. What you do over there is you count the years over here, you count the cash flow, you count the discount factor, which is a borrowing rate of 28%, because the rate implicit in the lease is not available. Okay, so we are paying this for what, 5 years? It is done in arrears, isn't it?
Yes, sir.
So we have five rental impairments made for the lease period. So we have 1 to 5, and every year we are paying 10 million. Is that correct?
Yes, sir.
So what will be the annuity factor?
$2.532.
2.532. That will give us 25.32, isn't it? Okay. At the date of the arrangement, the lease liability is what, 25.32. There's no direct cost, so our right of use will be the same as that amount, isn't it?
Yes, sir.
Okay. We are entering into this arrangement at the what? At the time that we are doing the reconstruction. So we haven't used the asset for any. No, we are preparing the statement of financial position immediately after the what? After the reconstruction. So we have actually leased the asset, but we haven't used the asset. We haven't started using the asset. So no issue of depreciation, no issue of finance cost, because we are preparing the financial statement at the time of what? The lease, not at the end. So you just go to your statement of financial position, have a lease liability of 25.32 and a right of use of 25.32. That is all. No finance cost, no depreciation, because we are doing this at the end or at the time that we are doing, or we are preparing the financial statement. Financial statement will be prepared from the beginning of the new firm, from the beginning of the year of the new firm. And we are doing this arrangement from the beginning, not at the end. We only depreciate when the asset has been used. We only charge the finance cost when we have used that particular portion. So the asset has not been used. So no direct cost, and no depreciation, and no finance cost. So you come over here and have right of use. So you separate it from the PP. If you have to add it to the PP too, no problem. So you have a right of use of 25.32. We recognize a corresponding lease liability of 25.32. Okay. Antivec 4.
B. Tangible assets, excluding the ones taken over by the directors, see note J below, have a revised value of 395 million cedis, whilst the unamortized development expenditure is to be written off. Allowance for credit loss of 17 million cedis is to be set up against receivables and inventory written down by 23 million cedis.
Okay, so we are going to be doing, you can see that you are in one footnote, you are giving 4.
So many.
Okay, you are giving 4 issues.
Minute.
Okay, so we will look at the tangible assets letter. That is one. With that one, they say we should see footnote J. Okay, but they are saying that the amortized development expenditure is to be written off. That is what? That is an asset, isn't it? If we are writing an asset of gain or loss.
Loss.
Okay, so we come to this one and have the capital reduction. We will be having a development expenditure over here. How much is that? How much is the development expenditure? That is 88.
88,000.
So we have We go and remove it. So 88, it means that this will be 0. So let's come to the additional one. Leave the tangible asset first. Let's do the simple ones. The one that we can actually do. Okay. Let's come to issue about receivables also. They are saying that allowance for credit loss of 17 million is to be set against receivables. What are they saying there? Allowance of 17 million is to be set up against receivables.
That is bad debt.
Bad
Okay.
debt.
So that bad debt is an expense, isn't it?
Yes,
Yes,
sir.
please.
Okay. So you come over here and have receivables. Okay. Receivables of 17 million. We go to current assets and remove what? 17 million from the receivables. I hope that is okay.
Yes, sir.
The receivables is included in the current assets. So we go and remove that one. We come back to the next one. An inventory written down by what? 23 million.
23 million.
What are they saying?
Inventory write down.
Okay. So we should what is the meaning?
Obsolete. It means that our asset will go down by
Reduced by that.
Okay. So we are going to be writing the inventory down by
Debit
what?
capital reduction.
So we have inventory over here to be 23, isn't it?
Yes, sir.
And our current asset will reduce by what?
23.
23. Okay. Let's now go to the J. Let's now go to the J. Deal with the J. Then we know that we are done with the anything concerning what? Concerning the D. Okay. So they say tangible assets, excluding the ones taken over by the directors. See notes J below. Have a revised value of 395 million. While the amortized, we have done that part now. Let's come to the J.
J. Some tangible assets whose carrying value and market value are 46 million and 58 million cedis are to be taken over by the directors in full settlement of their loan.
Okay. So they are saying that the directors are taking over what? Some categories of assets whose carrying value is what? 46 million and a market value of what? 58 million
58
are to
million.
be taken over by the directors in full settlement. Please don't say that they have not added respectively over here. This should not be a respectively figure. It's the same asset. If we put certain assets together, they are worth what? The carrying value is 46 million, but their market value is what? 58 million. It's not just one asset. It's asset that is being put together. So the directors are the director, or I don't know whether it's one director or if they are plenty. Okay. But directors are taking over a group of assets. Okay. It means that one asset cannot actually pay the money that we are owing the director. So we have to put some assets together. If you put those assets together, their carrying value together is what? 46. And their market value together is what? Is 58 million. Don't say that they say some tangible assets whose carrying value and market value are 46 million and 58 million. We cannot add respectively here because this value is relating to only one item. Is relating to only one item, which is the asset, which is a group of assets. So the asset is having a carrying value of 46 million, and the directors are taking it at what? At 58 million. The market value is 58 million. If the directors want to take this asset, they will take it at market value, or you go and sell the asset and bring the money to them, or you use the money to settle them. So the directors are taking this particular asset at what? 58 million. But the asset in our books is 46 million. Okay, we come back over here. Let's go to the director's loan. Let's go to the director's loan. How much is a director's loan?
58.
But they are receiving payments up to the value of 58 million, isn't it?
Yeah.
Sir.
What is happening there?
A gain of 10 million.
Okay, there will be a gain of 10 million. So we have directors loan. Okay, directors loan. We are owing them 68, but they are receiving assets to the value of 58. That means they are waiving what 10 million of that one. Are we going to be having any directors loan in the books again?
No, please.
No.
Okay. So you come here and take all the 68. If you like, you can have 58, then you have minus 10. So 58 will be from the asset, and 10 will be from the capital reduction. Whatever be the case, directors, you are not going to be owing directors, or you are not going to be having any directors loan in the reconstructed what firm. Let's come to how the J will be having effect on the what? On the D now. Okay, let's come here. Okay. The asset in our books are the assets carried at carrying value or market value.
Carrying
Carrying
value.
value.
The assets are carried at carrying value, isn't it?
Yes, sir.
So let's come here. The asset is 46 in the books, but now we are giving it to the people at what? 58. What is happening there? What is
There's
happening
a,
there?
There's a gain
there's
there.
a gain.
Gain
There's
of
a gain
12.
of 12 million, isn't it?
Yes, sir.
Very interesting. Okay. So this is what we do. So it means that the sale of the asset itself is going to be giving us a gain. Okay. So we have a gain on transfer of PP, or we can put, we might be having a gain or something. So we can, I'll just put transfer of PP over here. Transfer of PP. And that will give us the asset is, we are transferring at 58, but the asset in our books is what? Is 46. So there will be a gain of transfer, which is okay. So this is the entry that we are going to be passing. Let's come here. Okay. Let me just pass this entry, very simple. Before we what? Before we transfer the asset, we have to revalue the asset. So what will happen is that we have debit the PPE, because we still have 46 in our books. So we add 12 to make it 58. Then we now do credit revaluation surplus. Okay, that will give us 12. Then after this one, the asset will now be 12. We add a 12 to our asset now to have 58 in our books. Okay, then this one, what we do is that we're going to remove the PPE now. The asset will now be removed at 58. Then we now credit the loan at 58. Okay, but the loan is supposed to be 68. So what we have to do is that we have to come and now we have to, it's supposed to be, I'm doing the reverse of this one. So it's supposed to be debit the loan of 58. Then the loan will be, we credit the PP because we are removing the PP and we are settling the loan. But the loan will be remaining 10 million again. That must be removed. So we debit the loan again with 10 million. Then we credit capital reduction or the revaluation surplus. That will be 10 million. That's what we have done. Okay. So the gain on the asset has been recognized. The gain on the settlement of the loan has also been recognized. But let's count the impact of this on our assets. The asset is still included in our books at 46. So we have to go and take the asset off from our books and now revalue the remaining one. Okay. So let's come here. Let's come to this particular footnote again, the D. Okay. Okay, the tangible assets, excluding the ones taken over by the directors. Okay, so let's come to the tangible assets here. What is the total value of our tangible assets? It's 404.
It's 404.
Okay, included in this particular value is the 46 that the directors have taken, isn't it?
Yes.
Okay, because this asset over here is the total asset. Okay, it is the time that we are doing the reconstruction that the directors have decided to take the asset. So they are taking the 46. These assets are included at carrying value. So directors have taken an asset which is carried at 46 in their books. So we come and take the 46 from here. So if those assets have been taken, what will be the remaining value of the what? Of the assets?
358.
358. Okay. And they are saying that this has been revised to what?
395.
What is the difference?
37.
Okay, the 37 represents what?
Again.
Okay. So this is why you pass the entry over here. So you come to this one. We have property, plant, and equipment. That will be again. Okay. So if you like, you can just add a 2 and you'll be having 49. But this is the entry that we are going to be passing. Okay. First of all, we have to remove the 46 from the asset, isn't it?
Yes, sir.
Then we add 37 back. Is that correct? If you take the 46 over here, it will be left with 358. But they are saying that they should have 395 now. Okay. This
Yes, sir.
120 is the new asset that we have bought. This is a new asset that we have bought. That is the 120. But the asset that is affected is the one that we have in the books. 46 out of this taken away by what? By the directors. And now they are saying that the remaining one, which is supposed to be 358. So if you take the 46 from this one, you're having 358. But they say the 358 now should be 395. So you have to add a 37 here. So the 37 that you are adding over here is the effect of that. Okay. That is going to be a very simple exercise. Okay. It's not a difficult issue anyways, but okay. Anti-Vic, the E. Anti-Vic, are you with us? Auntie Victoria, you are there. Can you hear us?
Hello, sir.
Yes, please.
I want to ask a question about the capital reduction and the rest. During the intervention that was done on Monday, the lecturer talked about a case where you would have to set up a new company
That is the
and
external.
then,
That is the external reconstruction that I'm talking about.
okay. So are we going to solve a question on that?
Yeah, I will bring a question. Okay, but
Okay.
the treatment is not different from this one. But this one you transfer everything to the new company now, but you have to do the reconstruction first. You close the first company and send all the assets to the new one. Okay. So
Okay.
it's not different. What all the things that we are doing over here, all this restructuring that we are doing under this one, this will not be, if it should be external reconstruction, this will not be in the name of what? Of the old company again. It will not be in the name of the new company. So the asset that will be left
Okay.
will not be transferred to the new company. It will be in the name of the new company. So I'm sure I will get question on that. Okay. I'll get
Okay.
question on that. Okay.
All right. Thanks.
All right. Auntie Vic, where are you?
Please, I'm here. Sorry, I went off.
The
E, footnote E, 10% preference dividend are 5 years in arrears. The shareholders have agreed to waive three-fourths of the full amount and receive new 20% preference shares for the remaining. 10% preference shares are to be reduced to 0.2 Ghana cedis each, and the remaining capital converted into new 20% preference shares.
Okay. So they say 10% preference dividends are 5 years in what?
Arrears.
Okay.
Yes.
And the shareholders have agreed to throw away what 3/4 of the full amount and receive new 20% preference shares for the remaining. So we have to calculate
Yeah.
the preference dividends now, isn't it? Okay.
Yes, sir.
So we see that the preference dividend calculation, the calculation of the preference dividends is just the rate multiplied by the amount that they have. Okay. So that will be every year will be 10% multiplied by 80, isn't it?
Yes, sir.
Okay. So let's come here. Okay. So let's do the calculation of preference dividends. The preference dividends, annual preference dividends will be 0.1 multiplied by 80. That will give us 8, isn't it?
Yes, sir.
Yeah.
Okay. 5 years in arrears will give us what?
40 million.
Okay. They are saying that they are willing to what? Throw away 3/4 of this one, isn't it?
Yes.
And they will receive what? 20% preference shares for the what? For the remaining what? 1/4. So it means that they are paying 75% that way and they are receiving. Okay, so what will give us a 1/4?
30 million.
Are you sure? The 1/4 will
No.
be 10.
10.
Okay, that will be 10.
10.
Okay. Please, the treatment of this particular one depends on whether they have the preference dividend in their books. Is there any indication that they have the preference dividend in their books? From the statement that we have over here. Do they have preference dividends in their books?
No, sir.
No, sir. Okay. So what it means is that the entity, the preference dividend, the preference shareholders have told the entity that they are not going to be receiving the what? The dividends. They are not going to be receiving the dividend. So the entity has treated this particular dividend as what? As a gain, because the people are saying that they are not going to be receiving it. That's why they don't have it in their books. If they are saying that they are going to be receiving, they will have it as a what? As a liability. So they don't have it in their books. It means that they are first recognized as a gain. So if you are owing me and I'm saying that I'm not going to receive the money again, it means that you're not going to be having any records in your books as owings to me. No. That is what is happening over here. But after some period, I'm not telling you that pay me 1/4 or pay me 25% of that particular amount. It means that the amount that you should have recognized as revenue or a gain should be 75, not 100%. Okay. So the entity has written off or has recognized the 40 million as what? As a gain. Okay. Which has been taken to profit or loss because the people are saying that they are not going to receive the dividends. Now they are asking the entity to what? To pay 1/4 of that. So you have to pay 10 million of what you are what you have recognized first. So it means that they have to recognize 30 million as a gain. The 10 million must be what? Must be reversed. So when the preference dividend, when there is no entry for the dividend in the books, please, the shares that the entity will be issuing to what? To settle the portion of the dividend that they will be settling, please, that is treated as extra cost. That is treated as a loss to the entity. Because you have first recognized all the 40 million as a gain, because the people are saying that they are not going to be receiving it. That's why you don't have any records on it. Now they are saying that pay 10 million out of that. It means that the 40 million, you have to reverse what? 10 million out of it. It was first recognized as a gain. Now you are paying 10 million. That will be a reduction. That will be a cost. That will be a loss. You have to reverse what? The 10 million out of the 40 million. But if in the books, the entity is having records, okay, the entity has records on what? On the 40 million. So they have the 40 million in their books as a liability. So in the statement of financial position, we have the preference dividend and it's 40. So 40 will be a liability and the preference shareholders are asking them to pay 10. Then the 30 will be treated as a gain. 30 will be treated as a gain if they have the dividends in their books. But in this case, we don't have the dividends in our books. So we have to bring the dividend back to our books before we pay. So this 10 million will be treated as what? As a cost to the entity. This one will be treated as a cost to the entity. How will the entity go about this? Let me pass the entry so that maybe the double entry can actually simplify it. Okay, so we come here. The entity will now do this. Okay, the entity will bring the liability to their books. They don't have the dividend. So the entity will now debit profit or loss, okay, of 10 million. And they will now bring the liability now, which will be the dividend. So they will now create the liability. So the dividend will now become a liability of 10 million. What will be the corresponding entry? It will be debit what? Capital reduction account. Okay, that is how we go about it. The 40 million that is not in the books has been recognized by the entity as a gain because they are owing the people and they don't have it in their books. It means that the people are saying that they are not going to be receiving the money. That's why it's not in the books of the entity. Now they are saying that pay back, you have to now incur a cost of paying the 10 million back. So this particular 10 million, what we do is we now debit our capital reduction account. We have preference dividends of 10 million. Okay. Then we now have the liability. Debiting the capital reduction now means that we now have the liability. Okay. We now have the liability in our books as dividends. So we now bring the dividend to our books now. Okay. The dividends will now be, so let's say we are bringing the preference dividends here in the books. Okay. So let me bring the preference dividend over here to, okay. So I'll bring the preference dividend to our books now as a current liability of the 10. Okay. Now, let's look at how the question is saying. Okay, I'll just remove this one and we just do the entry at once. Okay, let's come to this place. They are saying that they are willing to waive what? The 3/4 of the full amount and receive 20% preference shares for the remaining. So the preference dividend of 10 million now, we are going to be issuing preference shares to settle it, isn't it?
Yes, sir.
Okay, so this will now be removed from this place. And we now be taking this one to 20% preference shares now. So it means that we'll be issuing, instead of us paying them cash, we are now issuing them what? 20% preference shares. Or we have issued 20% preference shares for cash and we have used the cash to pay the dividends. What I want to say is that you can decide to remove this one off. The entry will be between the capital reduction and the 20% preference dividends. Very simple. So you are now settling that with preference shares. So debit the capital reduction as a cost, and the preference shares will now be treated as what? As equity, or as part of equity, or as part of the liabilities. That is all for that particular one. Okay, so I've taken this one. I just want to demonstrate the meaning of that one because we don't have time and we are solving this question under exam condition. We have taken that one off now. Okay, let's come here. There's another issue in this one. 10% preference shares are to be reduced to 0.20 or 20 pesos each, and the remaining converted into new 20% preference shares. Okay, so the 10% preference shares, let's go there. Let's go there. Okay, what is the value per share?
1 Ghana cedi.
Okay, so they say that it should be reduced to what? 20 pesos, isn't it?
Yes, sir.
Yes, sir.
So how much are they writing off per share?
80 pesos.
Okay, 80 pesos. So the question can tell you that the preference shareholders are willing to write off 80% of what? Of the existing amount. So they are reducing, instead of what? 1 cedi, they are now reducing it to what? They are now reducing it to 0.2. It means that they are writing off 0.8. 0.8 per share. The number of shares is 80 million. 80 divided by 1. So we want to know the what? The amount that they will be writing off. That particular amount will be a gain to the entity. So we have preference shares over here. We have preference shares over here to be calculated as 0.8 multiplied by 80. How that is cool. They are reducing to what? To 0.2. It means that they are writing off, or they are telling us that we should reduce our shares by 0.8 because it's 1 cedi. If you are reducing to 20 pesos now, it means that you are saying that we should reduce by what? 80 pesos. That will give us 0.8. What are we having as the final answer?
64.
Okay, so it means that we are going to be reducing this one. Another way to do this one is that you just find the number of new shares, the value of the new shares now, 0.2 multiplied by 80. That will give you 16. So the new preference shares will now be 16. Okay, the new preference shares will now be 16. It means that you are reducing the existing one by 64. Okay, let's now come here and have 64.
Hello, sir.
Yes, please.
So please, if you are having a share and then the rate was, let's say, 1 Ghana cedis, and now you have to write it down to, let's say, 0.2 or 20 pesos, it's not going to be a loss to us.
Okay. Yes, now can you take that one again?
Yes, sir. So I was saying that previously the 10% preference share was valued at 1 Ghana cedis. And now they are saying that we should write it down by, let's say, 20 pesos or reduce to 20 pesos. Is that not going to be a loss against us?
If the question is saying that what?
See, the 10% cumulative, he said that it was valued at 1 Ghana cedis each.
Yeah.
Now, they are saying that it is to be reduced to 0.2 Ghana cedis.
Okay.
So reducing it from 1 Ghana cedis to 20 pesos, is it not going to be a loss to us?
Who? To the entity or the shareholders?
To the shareholders.
We are doing this for the entity. So it will be a gain to the entity, not the shareholders. We are not doing this for the shareholders.
Okay. Okay.
I hope you're okay now.
Yes, sir.
Okay. The entity is supposed to pay you 80. Now you are asking them to pay you 16. Okay. So it means that it will be a gain to the entity. We are not doing this for the shareholders. We are doing this for the entity. Okay.
Okay. All right.
So let's come to the wage part there. There is another one there. And they say, and receive 20% preference shares for the remaining. Okay. The 10% preference shares are to be reduced to 0.8, 0.2 each, and the remaining capital converted into what? Into 20% preference shares. So the remaining capital is what? After the reduction, what will be the remaining capital? After the reduction of the preference shares, what will be the remaining capital for them?
16.
And they say the 16 to be converted to what?
20% preference share.
So we are not going to be having any 10% preference shares again. We add it to this place. So you remove, it means that no 10% preference share. The 16 should not be there. We now change the 16 to what? 20%. So this entry will just be between the 10%. You remove the 16 and you now send it to what? 20% preference shares. Okay. You now send it to 20% preference shares. Okay. Yeah, that is for that one. The F. Let's see what will happen. Auntie Vic.
Linus, please, I want to ask a question.
Okay.
The 3/4 of the full amount that has been waived, are we not going to do anything to that one?
We don't have records on that one, so we only record the amount that we are paying.
I don't understand.
We don't have records on the liability. Okay.
Okay.
The dividends, we don't have records. The amount that we are paying is the one that we are going to be recording.
Okay. F. The existing ordinary shares are to be written down to 0.4 Ghana cedis each. All ordinary shares are to be consolidated into shares of 10 Ghana cedis each. The equity shareholders are willing to introduce additional capital to compensate any losses arising from the reorganization.
Okay. Okay. So they say that the existing shareholders are to be written down to what? 0.48. Okay. Each. Let's go there and see what is the value of each share. What is the value of a share for the preference shareholders?
1 cedi.
1 cedi. Okay.
1 cedi.
But they are saying that the new value, the share price in the new firm now, okay, should be what? We are taking only 0.4 per share from this one to the new firm. Is that what they are saying?
Written down to.
Okay.
Yes,
So
sir.
we are taking 0.4 per share from this one now to what? To the new firm. It means that we are leaving or reducing what?
Gaining.
is by 0.6. So let's look at the gain there.
Yeah.
So we are reducing by 0. What? 0. So we have the ordinary shares. Ordinary shares, we are reducing by 0. What? 0.6. So we have 0.6 multiplied by 320. What are we having?
One nineteen.
119.
192.
192.
Okay. So we go and reduce the equity share by what? 192. So let me do workings for the equity share somewhere. So we have the ordinary shares now. So we have the balance brought down to be 320. Then we have the capital reduction. Capital reduction to be 192. Okay. So that is for that particular one. And they say the remaining one should be what? Don't be confused with whatever they are saying there. They are making a statement over there. All ordinary shares are to be consolidated into what?
10 cedis each.
Okay. What they are saying over here is that in the new firm, ordinary shares will now be valued at what? 10 cedis. Okay. So what is the remaining amount that you are going to be having? This will only affect the number of shares. You are going to be having 0.4 multiplied by 320, isn't it? That will be the equity shares in the new firm now. That will be
128.
okay, 128. So these shares that we are taking to the new firm now, it will be valued at what? At 1 cedi each.
10 cedi.
Okay, as 10 cedi rather. So this is actually what? This is actually what? The value. So we are sending only 128 million of the existing equity shares to the reconstructed firm. But the shares in the reconstructed firm will now be valued at what? At 10 cedis. So how many shares will give us the 128? It will now be 12.8 shares valued at what? 10 cedi. That will give us 128. Okay. So the value of the equity that we are selling there is 128. But this will now be converted to shares at what? At 10 cedis. So that will now be worth only 12.8 million shares instead of the 128 million shares that we have first. So we are consolidating every value in the what? In the constructed firm or in the reconstructed firm will be valued at what? Any share will be valued at what? At 10 cedis. So if you are sending the 128 million Ghana cedis to that place, you are going to be having only 12.8 shares, only 12.8 million shares. It doesn't change the fact that you are sending 128 there. Your value that we are sending to that firm is 128 million. The value of your shares that we are selling there is 128 million. But those value will now be converted to shares issued at what? At 10 cedi. That's what they are saying. So in the reconstructed firm, all shares will now be valued at what? At 10 cedi. That's what they are saying.
Hello, sir.
Yeah, hello.
Yes, please.
Hello, sir.
Yeah.
But will that particular share figure 128 have effect on the new capital's shareholder share account?
No, please. The value that you are bringing is 128 million. But this 128 million in the old firm, you are having 128 shares. But in our firm now, our shares are valued at what? 10 cedis. So it means that you'll be having only 12.8 million shares.
Okay.
All right.
Yes, hello, sir.
Yes, please.
Yeah, please, can you go over the conversion of the loan to the 10 cedis again?
Okay. Which loan? There's no loan here.
Sorry, ordinary shares rather.
Okay, we are saying that existing shareholders are to be written down to what? 0.4 Ghana cedis each, isn't it? Okay. In the new firm, the people are sending only 128 million Ghana cedis as equity shares from the what? From the old firm to the reconstructed firm. Okay. But in the reconstructed firm, our shares are valued at what? At 10 cedis. So in this particular firm now, instead of you having 128 million shares in the old one, your 128 million that you are bringing now will only attract 12.8 million shares. That is it. So after everything, all shares will be valued at what? At 12 point, at 10 Ghana cedis rather. Okay, so it's not going to be changing the what? The value that they are bringing, that you'll be doing 128 multiplied by what? 10. No, that will give you 1280. The 1280, how much is the people bringing? If you want to have 1280, it means that you are issuing new shares and the people will pay. But they are going to be bringing 128 million Ghana cedis of 128 million Ghana cedis to the new firm. But in our new firm, any share that you are bringing or any value that you are bringing, it is going to be measured at what? At 10 cedi. So we give you 12.8 million shares. That will give you the what? The 128 million. So that is not going to be imparting, or you're not going to be doing 128 multiplied by 10. No. If you are doing that, it means that you are saying that the entity has issued new shares and the shareholders have bought it and the cash is increasing. No, that is not the issue.
Okay, so I wanted to find out. So with the conversion to 10, it only affects the number of shares, not the value.
Not the value.
Only the number of shares.
Yes, please.
Okay, because initially it was being written down to the 0.4.
That is the
So
old
right now
firm.
that's the old firm. So
Okay.
right now you're converting that one into a 10 cities, which means the number of shares you are holding whilst you were 0.4 will rather reduce because you are converting it to 10.
Yes, please.
Okay, thank you.
If you have 100 million in a company where a share is valued at what? At 1 cedi, you are taking that 100 million to a different firm where the shares is valued at 10 cedi. Will you be having the same number of shares?
No.
No.
Will it change the fact that you are bringing 100 million to the new firm?
No.
That is what is happening over here. You have 100 million, which is giving you 100 shares or 100 million shares in the first firm. You are bringing the same 100 million into a new firm where their shares are valued at what? At 10 cedi. Only your number of shares will reduce. The value that you are bringing will not reduce or will not increase. That is the issue that is happening here. Okay, I hope we can actually now move in peace, and God will be with us. Okay. The
Amen.
equity shareholders are willing to introduce additional capital to compensate any losses arising from the reconstruction. But we will look at this particular statement when we are done with the capital reduction account. If there is any loss, it will still be what? It's the equity shareholders will bring money to take care of that particular one. That is what they are saying. Okay, let's take the gene now. Auntie Vic.
Sorry, I muted myself. Jane, after somewhat successful discussion with the bank has now agreed to accept conversion of 80% of its claim into 25% secured bonds and the remaining 10 into ordinary shares. Of all 15% debentures are to be converted into 30% unsecured debentures, except the holdings of one unsatisfied debenture investor. This investor is to be paid 75 million cedis as full settlement of its claims of 80 million cedis.
Okay, so we take it one by one. Let's say after some discussion after discussion with the bank has now agreed to accept what? Conversion of 80% of its claim into 25% secured bonds. So let's go to the bank. What figure are they talking about? A bank over there. That is a bank overdraft, isn't it?
Yes, sir.
So how much is a bank overdraft? It's 100 million, isn't it?
100 million. Yes, sir.
Okay. They are saying that they are converting 80% to what? 25 secured bonds. Okay. 25 secured bonds. That will be a 25 secured bonds will be a long-term liability. So we have 25 secured bonds. Okay. So 80% of that will give us how much?
80.
That will give us 80 million So we go and reduce the bank overdraft by 80 million. I hope that is okay. So we transfer 80 million of the bank overdraft to what? To secured bonds now. So 80 million of the bank overdraft will now be seen as secured bonds. So we are owing them only 20 million. Let's go to what the question is saying for that particular portion again. Okay. They are saying that the remaining one is to be converted into something. Okay. Okay. And the remaining 10 into what? Ordinary shares. What will be the
Ordinary
remaining
shares.
amount? What is the remaining amount?
20
So the 20 will
20%
now
of
be
them.
converted to what?
ordinary shares.
So there will not be any bank overdraft in the books again, isn't it?
Yes, sir.
So we now have bank overdraft as a conversion towards ordinary shares. So we have 20 here. I hope that is fine. Okay. There is no gain or loss on that one because we are paying all the 100 million that we are owing the bank in different ways. Okay. Let's come here. All 15% debenture are to be converted into 30% unsecured what? Debentures, except the holdings of one unsatisfied debenture investor. What it means is that after we have what? We had a discussion. After we have a discussion with the debenture holders, one of them is not what? Is not satisfied with what? With the terms or with the what? With the picture that we are presenting to him. So what happened is that he said he's not going to be converting his own. So this is what we are going to be doing. All 15% debentures are to be converted into 30% unsecured debentures, except the holding of one unsatisfied debenture investor. This investor is to be paid 75 million as a full settlement of its claim of 80 million. So how much are we owing this person first? The one who is not satisfied. How much are we owing that debenture, that holder? How much is the entity?
75.
No.
80.
80, sorry, 80.
Okay. The owings is 80. Okay.
Mhm.
And we are paying how much?
75.
Okay.
Five.
So what is happening there?
25.
A gain of 5.
Gain
5
of
million.
5.
Okay. So let's bring the gain over here first. So that will be debenture. The debenture you'll be having 80 and you are paying 75. So this will now give us 5 here. Okay, let's go and pass the entries for this one. So 80 will be taken away from this, isn't it? And 75 will be taken away from current assets. Think about it. We are paying, so cash will be reducing, isn't it? We are paying 75, cash will be reducing. Is that correct?
Yes, please.
Okay. And the debenture holder, the total debenture is 200, and we are paying the person that we are owing 80. So 80 out of this has already been settled. So we have paid the person 75, and the person has what? The person has let go of what? That 5 million, and we have recognized the 5 million as what? As a gain. So this was the entry that we are passing. We debit the debenture, the 15% debenture of 80 million. We credit cash or bank with 75 million. Then we credit profit or loss, which is the same as a capital reduction. That is the entry that we have done now. So this is the entry that we are going to be passing for this particular transaction. So we are removing the 80. We have paid the person 75 for the full settlement. So 80 of the debenture will not be there as owings again. So we have paid the 80. That will be going. We have what? We have paid 75. We have made a cash payment of 75. So our cash will be reducing. It means that we are receiving a gain, or we are saving what? That particular 5 million, and that has been taken to the capital reduction account as a gain. That is the entry that we have to pass. And that is what we are done that particular one. So the debenture, 80 million of the debenture will no longer be there. 75% of your cash will be reducing, and 5 million will be treated as a gain. Okay, let's come to what they are saying about the remaining of the debenture there. Okay, all 15% debentures are to be converted into 30% unsecured debentures, except the holding of one satisfied investor. So after we have settled this particular investor who is not satisfied with the terms that we are presenting to the debenture, to the investor, how much will be left?
120.
And this 120 will be converted to what?
30% unsecured.
30% unsecured.
So we now
Eh,
subtract the 120 over here and make it what? 30% what? Unsecured what? Debentures.
Mm.
Okay. And that will be 120. Okay. It's plenty, but don't worry, it's very fine. All right, so we are done with that particular one too. But if you use a double entry, that will be fine. But just that it will take your time. Okay. H. Let's take the H there and see.
H.
Okay.
As part of the restructuring, 10 employees have agreed to receive severance payments totaling to 3 million cedis in exchange of arrangement to have their employment terminated. Payment is expected to be made within 3 months. A long-term purchase commitment with a value of 100 million cedis is to be terminated at a penalty payment of 0.4 million cedis.
Okay. So this is just like a provision. So as part of the restructuring, we are what? Some people are going to be laid off, isn't it?
Yes, sir.
And as a result of that, the entity has to pay their redundancy what? Fee. Okay. And they are saying that the total amount is what? Is 3 million. Okay. And we are also terminating what? We are also terminating a long-term contract with a value of 100 million, but we are going to be paying a penalty of what? Okay. We are going
400,000.
to be paying a penalty of 0.4 million. Okay.
Mm.
As are these dates, what is the total expense? What is the expense that we are going to be making? Or what should be the provision that we are going to be making for this particular payment? We are going to be paying the people 3 million. Okay. That is a redundancy cost or redundancy payment. We are paying this because of the restructuring. So that's an expense to us. If we should be preparing profit or loss at this particular date, we will treat this particular 3 million as a provision. Okay. What about a penalty also?
We need to make provision.
Okay. So it means that we are going to be incurring an expense of 3.4 million. Is that correct?
Yeah.
Okay.
Yes,
So we
sir.
have a provision of, so we make a provision of, so let me come here. I'll have provision of 3 plus 0.4, and that will give us 3.4. Okay. They are saying that the entity is to pay the penalty. If you assume that the penalty has been paid immediately, to no problem. But if it has not been paid, then you bring all the 3.4 over here as a provision. That will be what? That will be settled. The severance payment will be made within 3 months. And the penalty, we don't know when it will be paid. But if you have taken it from cash, assuming that it has been paid immediately, there is no problem with that one. Okay. But we just assume that they are here to pay all of this amount. So the total provision will be 3.4 as an expense. Okay. So that is what we are going to be doing over there as a provision of what? So we debit our profit or loss, which is a capital reduction. Then we now credit a provision as what? As a liability, a non-current liability. Okay. Answer Vic. Last one.
I. Contingent liability disclosed as 2.6 million cedis has finally crystallized for 1.9 million cedis, but the payee has agreed to receive new 1.5 million cedis 25% secure bonds as full settlement.
Okay, they are saying that contingent liability has been disclosed. Okay, the contingent liability can actually be a court case against us. Okay, and we don't know what will happen. So we are just saying that okay, currently there is a court case against the entity, and we don't know what the outcome will be. Okay, but we are optimistic that we are going to be paying 2.6 million. Okay, but they're saying that this particular amount now, the court has now passed their judgment, and the entity has to pay what? 1.9 million, isn't it?
Yes, sir.
Okay, but the person agreed to receive what?
1.5.
So what will be the expense that we are going to be making now? what will be the expense that we are going to be recognizing based on this transaction? What will be the net expense? We're supposed to pay 1.9, but the person wants to receive 1.5. But you have to know that the 1.9 is not in our books. We are here to recognize this one because they say it has been disclosed. So we are here to recognize it. Okay. But if the person don't want to accept anything, we should have what? We should have recorded what? 1.9 as a liability now. And we recognize expense as what? As 1.9 because we are going to be paying this amount now. It's a cost that we are going to be paying. It's a penalty that we are going to be paying. But this penalty is not in our books. So the amount that we are going to be paying the person will become the expense. So we have disclosed it. Disclosed means that we only have it in the notes to the account that there is a liability like this, like this, like this. Now this particular one has actually crystallized. What it means is that it is now a liability now. It is now a payable item. You have to go and record it now in your books. But the person is saying that he or she is going to be accepting 1.5. So what are you going to be recognizing in your books as a liability?
1.5.
1.5. Okay.
Yes, please.
So the 1.5 is the net amount. If you want to recognize the 1.9 and you reduce it by 0.4 and have a gain. So if you are recognizing 1.9, 1.9 will be the cost. Then you have a counter gain of 0.9. It will reduce to 1.5. Just record the net amount, the amount. Okay, the amount that the person wants to receive, and that will be, we have a contingent liability of, so we come here and have a contingent liability that will be an expense to us. Then you recognize 1.5, and the person is receiving what as the settlement?
25% secure bond. Oh.
Okay. So we add a 1.5 to 25 secured bond. The entry will be debit your profit or loss because it's an amount that you have to pay, credit your liability, which is a 25% unsecured what? Bond. Please add the capital reduction account, and I will use it to explain what they are saying, that the equity shareholders are willing to introduce introduce cash to compensate any losses from the reconstruction. Let's add the two sides.
Yeah, hello, sir.
Yes, please.
Yeah, please, I do have a question. Pertaining to the one we just saw, the contingency liability. Hello?
We are together.
Okay, so if it was said that they made a provision of 2.6 and they criticized sorry, and he is
They are
supposed
going
to
to
pay
be paying.
1.9.
Okay.
They made a provision of 2.6. Right, and the actual amount they are supposed to pay is 1.9. Will it be a gain for the entity?
Yes, please.
It will be a gain.
Yes, please.
And at the end, they are settling for the 1.9 for 1.5. So will
That will
one
still be
be
a
also a
further.
gain?
That will still be a further gain. So in total, the gain will be
A gain
2.
of 11.
Yes, please.
So would he go to the capital reduction, the credit side as a gain?
They are saying that disclose and recognition are two different terms.
Okay.
The liability has been disclosed, not recognized.
Okay.
The liability has been disclosed, not recognized. Okay.
Okay.
Contingent liability disclosed. Disclosed means
Okay.
it's just part of your footnote, not in your financial statement. So they are
Okay.
here to recognize that.
So I get that one. So what about it is 1.9 and it being settling for 1.5?
You are
The
still
difference of
here
0.5.
you are still here to recognize the 1.9. There is no liability relating to the 1.9. You have disclosed 2.6 and they are asking you to pay 1.9. So if you are paying the 1.9, then you have to recognize the 1.9 in your books. But you are yet to make any entry relating to that.
So then it means that you debit the capital reduction account
by 1.9 if you are recognizing the 1.9 and you have the liability to be 1.9. Now you are paying 1.5, so you have a gain of 0.4. In effect, you are having a loss of 1.5.
Okay, sir. I get you.
You're okay
I
now?
get you. Thank you.
Okay.
Yes, please.
So there's no records in the books relating to the contingent liability. It has been disclosed just in the footnotes. So any amount that you are paying will become the liability that you'll be putting in the books. Okay. So let's total the two sides. Then I'll use it to explain why they are saying that so I'm having 390.9 at the
Yes, sir.
debit side. Okay. 390.9. And this one will give us what? 10 plus 12.
The difference is 90.9.
90.9. Okay. So 90.9, this will be a loss, isn't it?
Yes, sir.
Okay. The question is saying that the shareholders are willing to what? Are willing to introduce new capital to what? To take care of any differences. So you come over here, this one will be written against ordinary shares. Okay, that will be 90 points.
90.9.
Okay, so you go to ordinary shares, you have their ordinary shares over here. You have
The difference is 70.9.
70.
Yeah, 70.9.
Okay.
Not 90.9.
Yeah, so
So we have
70.9.
70.9. Okay. So they are saying that the ordinary shareholders are willing. So that reduction will come to ordinary shares. So we have losses from reconstruction. Okay. Losses from reconstruction. So that will be 70.9. But what they will do is that the question is saying that they are willing to introduce what? Additional cash. So, or to inject additional cash to cater for the loss. So they don't want their shares to reduce by the 70.9. So they will ask the entity to issue new shares to this particular value. Then they will buy. So what will happen is that the entity will now issue new shares to them. That will be cash. The cash will be 70.9. Okay, so that they can cancel the loss. The loss will not affect their existing capital. So they want to bring in more cash to cancel the loss. So the entity will issue what? Shares of 70.9 to them, and they will purchase. That will cancel the loss over here. And your cash will be increasing by the 70.9. So this is what you do. So they say that they are willing. So any loss over there will be treated as what? Issuing of new shares. The loss will be written against the equity shares. But the entity will issue new shares to them. They don't want their existing share value to reduce. So any loss that is coming in, it will be written against their capital. But they will introduce cash to what? To take off the effect of that particular one. So the cash will be coming in. So you take the loss to the equity share account, but the question is saying that they are willing to introduce. So this will be reducing their shareholding, but they don't want to reduce. So they will now purchase new shares to reduce the effect of this one. So they don't want their share capital to reduce. So that is how we go about this one. Any loss will be taken to the equity, and that loss will be treated as what? Issue of new shares again. That will be increasing equity and also be increasing the cash.
Hello, sir.
Yes, please.
So with this one, you don't factor in the working capital.
So the question is not asking for working capital. The question will basically ask you for the working capital. If they say they want a working capital, the question will ask you that a working capital of this amount should be introduced. Then that will be between cash and equity shares. They will tell you that.
Yeah, hello, sir.
Yes, please.
Yeah, please, with the treatment of the loan, please can you go over again the B?
Which loan? The loan. Why is which one are you talking about?
B. I'm talking about B. How you treated it.
The B over here is a standard on its own financial instrument. Just take this one as convertible instrument. Part of it is grant, part of it is debt. So find the debt component. The remaining one is the grant, just like equity component. I hope you know how to treat convertible instruments and financial instruments.
Yes, sir.
Okay, the same treatment over here. So instead of the equity, we name it the grants. All right, let's pick one question on this one. Let me do one question on the interpretation. Okay, we have the business valuation. We have tried that one in class, but just that I have added some things to it again. Okay, so let's look at the interpretation is 15 marks, so you cannot do away with that one. But now, what we have to do is, okay, you have to understand consolidation in relation to the interpretation. Okay, they can give you interpretation for a group account where they will be asking you to calculate the ratio for the group as a whole, and they also ask you to calculate the ratio for the individual companies. So they can give you acquisition. If there is an acquisition, what is the treatment? The parents has done the treatment already. It means that the parents has added the subsidiary figures to what its own figures. That's why they have the group revenue. The question can ask you to calculate the ratio for the group as a whole, and they can also ask you to calculate the ratio for the parent alone. What it means is that you have to take out all the effect of the what? Of the acquisition of the subsidiary on the parent figures. You have to do that. Last thing, it was on disposal. The same thing, just consolidation. They asked you to do it for the group as a whole. They asked you to do it for the individual companies. But the last question was to be calculate for the parent without the subsidiary. But the way they ask the question is confusing. Okay, they say you should do it after something. It should be excluding the issues of the other company. That is for the parent alone, without the result of those ones. So what do we do? The disposal was up to a particular level. The parent is going to be consolidating the subsidiary what? Statement of profit or loss item up to the date of disposal. So they have given you a full year for the subsidiary. You just find a portion of the revenue that the parents has taken to the parent revenue and other necessary adjustments that is within the group. You take it off and add. Then you calculate for the parent alone. That will give you the parent figure. So you can do the same thing for acquisition. Acquisition, the parent is going to be adding. If it's a full year, the parent will consolidate it for a full year. They will ask you to calculate it for the group as a whole. That is within, including the result of the parent together with your subsidiary. And they will now ask you to do it for the subsidiary alone. You take only the subsidiary figures. They will give you subsidiary figures. Then they will now ask you for the, calculate it for the what? For the parent alone or the investor alone. That means for the company, its own operations, excluding the result of the subsidiary. So you now ask yourself, when was the subsidiary acquired? For how many months? Okay, so how many months? The subsidiary has been consolidated for how many months? Then you calculate or you determine the revenue for that month and take it from the group revenue. The remaining portion, there can be some intra-group trading, but they will not give you because it's ratio analysis. So they will not give you much details. They'll just give you information. Assume that there is no intra-group trading. Find the subsidiary figures and take it from the revenue items of the parent. So take it from the revenue, take it from cost of sales, take it from the finance cost, it is the addition of the two that give you the group figure. So subtract that one. And the issue of the equity also, there can be a problem with that particular one too. You just have to adjust it, applying the issue of the consolidation. They can also give you a question where you have to work back some items. And that is what we are coming to do over here. Working back to get some items. That is what we are coming to do over here based on this particular question. Okay. Auntie Vic, if you are with us, then let's move on. Okay, let's take the ratio first and see what we can do. Okay, what are they asking us? Compute the following ratios of Ashdown for the years 2022 and 2021. So if you are doing ratio, it is very important to do it in a tabular form. Okay, so we have the ratios here. You have your formula here. Then you have the years 2022 and 2021. Okay. Then you have your figures here. So in the same company, we do it and move on. What is the first ratio that they're asking us to calculate? Okay, we are calculating gross profit margin. Okay, gross profit margin. How do we calculate gross profit margin? Gross profit over
Revenue.
sales times 100.
okay. So we have our gross profit over revenue multiplied by 100. So let's go and look for our gross profit and our revenue for each of the years now. Okay, so let's come here. Okay, let's come here. So let's come here. What will be our gross profit? What will be our gross profit?
For 2022, it will be 146.
146.
146.
Okay, how did you get that?
Like the
Sales
cost of
minus
the sales.
Cost of sales.
Okay, so we have 146 divided by 365, isn't it?
Yeah.
Okay, so we have 146,000 over 365,000 multiplied by 100. The second year, the 2021, what are we having?
$63 gross profit.
So 63 over 219, isn't it?
Yeah.
Okay, 63 over 219 multiplied by 100. What are we having as the ratios?
40% for 2022.
40%.
Um, 28.8%
Okay,
for 2021.
28.8%. Let's move on to the next one. Okay, the next one is net profit was margin. Net profit margin. How do we calculate net profit margin? Net profit before
Tax.
Interest and tax.
Interest and tax, sorry.
okay, divided by revenue multiplied by 100. Okay, so we know our revenue already, 365,000. And we are going to be having 219,000. So we have to determine our what? Our net profit now before interest and tax. Okay, how do we determine that? A very simple exercise here. How do we determine the net profit before interest and what? And tax for each of the what? The years.
We'll find our gross profit. Then we less the expenses.
You are not giving any expenses in the question here. So what do you
So,
do? What do you do?
I think the gross profit figure will still be the net.
will still be.
Hey, who is saying that? The company uses functional presentation of expenses and such as group expenses into cost of sales, administrative, operating expenses, finance costs, and tax expense. This aggregation of tax expense recognized in the income statement for the years is as follows. So these are you have to calculate the income tax. Okay, let's come here. Profit for the year. If you want to know the profit for the year, okay, this is how you calculate the
We
profit.
have the
Yeah,
group retained earnings. We can look for the increase.
this is not a group. This is just by one entity. Okay. This is just for Ashtown, one entity, so it's not a group. Okay. Calculating the net profit before interest and tax is very simple. Okay. The total dividend. So read additional information. Maybe additional information will now tell us what we can do. Answer it. Read that for us.
No.
Hello.
Read the additional information for us now.
Okay, additional information. A. Total dividends declared and recognized in the financial statement for the years 2022 and 2021 for all shareholders were 35,000 and 5,000 cedis respectively. Should I go ahead or
Let's
take some time?
let's be moving.
Okay. B. The balance of retained earnings at 1st January 2021 was 41,000 cedis. There was no bonus issue during the year 2022. C. The only movement in retained earnings for the 2022 and 2021 year were the profit for the year and dividend. D. The company uses functional presentation of expenses and as such groups expenses into costs of sales, administrative operating expenses, finance costs, and tax expense. The disaggregation of tax expense recognized in the income statement for the 2 years is as follows. We have the current tax estimate, overstatement in 2021, current tax after tax audits, understatement in 2022, current tax after tax audits, decrease in deferred tax for the year, increase in deferred tax for the year. E. The market price of the company at 31st December 2022 and 31st December 2021 were 1.8 and 1.5 cedis respectively.
Okay, stop there. So do we have an idea about how to calculate the net profit before interest and tax now? Reading all this one. Okay. Any idea? Okay. How do we calculate deferred tax at the end? How do we calculate retained earnings at the end rather, not deferred tax? How do we calculate retained earnings at the end?
Open retained as profit.
So we look at the change.
Okay. Opening retained earnings plus what?
Profit.
For the year.
Minus
Less
what?
dividends.
Okay.
And there's dividend.
Okay. So let's come here. Let's calculate the profit for the year. We know that the retained earnings for 2021 was what? The retained earnings at the end of 2021 is 55,000, isn't it?
Yes, sir.
Okay, let's come here. That 55,000 is calculated like this. So let's do this one. Okay. So I'll go to somewhere and calculate the profit for the year. Okay. So let's come to profit for the year for the 2 years. So I'll do 20, 21, and 2022. Okay. So we know that we are looking for closing retained earnings. We know that closing retained earnings will be done as balance brought down, which is a retained earnings. What is the opening retained earnings for 2021? The question has given us that. Okay. They have given us that the opening retained earnings was what? The balance on the retained earnings at 1st January 2021 was what? 41,000. So we have opening retained earnings to be 41,000. We know that opening retained earnings for 2022 will be 55,000. Is that correct? The opening retained earnings for 2022
Yes.
will be 55,000.
Yes.
Okay. Then we come to, we should add profit for the year will be increasing this, isn't it? Okay. Profit for the year. But we don't know, so we make it X and Y for 2. The 2. So we have dividends will be reducing this. Okay. Then the dividends, what is the value of the dividends for each of the years. The total dividend declared and recognized in the financial statement for the years 2022 and 2021 for all shareholders were what? 35,000 and 5,000 respectively. So for 2022 is 35,000 and for 2021 is 5,000. So we'll be having this one here and we'll be having 5,000 here. Okay, sorry. The first one should be 5,000. 2021 should be 5,000. And this should be 35,000. Okay, we know that the closing balance for 2021 will be 55,000. Okay, and this will give us a closing balance of what? 2022 is 60,000. That will give us a closing balance of 60,000. Okay. So can we now find our profit using small mathematics? We know that 41,000 plus the profit minus what? Minus the 5,000 will give us 55,000. So we can say that the profit so let me just do something here. 41,000 plus the X minus 5,000 will give us
19,000.
Okay, that will give us 19. Okay, so we have 5,000 minus 41,000 plus 5,000. That will give us 19,000 for the first year. So that will be changing. I just want to use this to demonstrate how it will be calculated. So I'll be changing this now. For you to calculate your profit, this is what you do. For you to calculate your profit, I'll be taking this one off now. So for me to calculate my profits, this is what I'll be doing. I'll be having a closing retained earnings, okay, of 55,000. Okay, this will be 60,000. So I have my closing retained earnings 60,000. I will add my dividends. Okay, I'll add my dividend for each of the years. That will give us 5,000. And I'm sure that was 15,000 rather. Okay, that was 35,000. So I'll add a dividend of 35,000. Then I'll be subtracting the closing retained earnings, the opening retained earnings rather. So I have the opening retained earnings of 41,000 and of 55,000. What will be our profit for the year? Okay.
19,000 for 2021.
Okay. And the second one give us what?
30,000.
Okay. 30,000. But this thing, we are looking for profit before tax and interest, isn't it? Okay.
Yes.
Our profit before, this is profit after tax. The profit
After
that
tax.
we send to retain earnings is profit for the year, which is profit after tax. Okay, so we come to this one now. We know that our profit before interest and tax will be the profit for the year plus interest and what? And tax.
And tax.
So we come to the finance cost over here, which is the figure given to us over there. Someone is saying that 2022 is 40,000.
Yes.
Okay. So we have 40,000. So our finance cost, we have finance cost in the question. Okay.
Sir, please change profit for the year, the 30,000 to 40.
Okay, thank you. So we have 40,000 here. So our finance cost in the question has been given to us 9,000 and 6,000 respectively. 9,000 and 6,000. So 6,000 will be for this one. And 2022 is 9,000. Then we now have to recognize the tax expense, the tax that has been taken to profit or loss. It means that we have to prepare our tax schedule. Okay, know the tax now. Okay, so we come to the tax schedule now for the 2 years. Okay, so we come to the tax schedule for the 2 years. So we have 2022 and 2021. If we are preparing a final account, how do we go about the tax? We bring the current tax under IS-12. We bring the current tax, add any under or over provision, any movement in deferred tax, isn't it? Okay. So we have the tax figure given to us over there. It's a very simple one, okay, but it's not easy. So current tax estimated, the current tax for each of the years is 14 and 8,500 for each of them. So we have 14 here and 8,500 here. So we now come to the effect of what those adjustments. What will be the tax figure? What is the tax figure that we have taken to profit or loss? We take the net amount, income tax, over and under provision, the effects. So let's come here. Overstatement in 2021 current tax after the tax audit in 2022. So it means that there was over provision relating to 2021 that has been dictated in what? In 2022. What is the impact of over provision on our current tax?
It will reduce.
Okay. So we have over provision. So we have over provision. So over provision was taken from this figure. That was 1,200, isn't it? And that was dash. There is no over provision for that particular year. Okay. Now, understatement in 2021, current tax after the tax audit. This is for only in 2021. Under provision, what is the impact of under provision on our current tax?
You add
Supposed
back
to increase it.
You add back.
So we have under provision. We are going to be having under
1,000.
provision for 2021, isn't it?
Yes, sir.
So we add 1,000. Okay, then we come to the movement in deferred tax. Decrease in deferred tax for 2021. Decrease in deferred tax is treated as a provision. So if there's a decrease in provision, that is going to be a gain. So decrease in provision is treated as a gain. That will be reducing our tax. So decrease in deferred tax 2021 will be a reduction. Okay. We have decrease in
Sorry.
yes, please.
There's something supposed to find the deferred tax, either deferred taxes or deferred tax liability, sir.
No, please. We're only looking for the movement. This is movement. Deferred tax, decrease in deferred tax. This is a movement in the deferred tax, not asset or liability. Okay. This is movement. This is a portion that has been recognized to profit or loss. So the deferred tax over there is always movement. Okay. Not asset or liability. We are recognizing only the movement. So that is a decrease of 1,500 in 2021, and that will be treated as a reduction. So we have a reduction of 1,500. We have increase in deferred tax. Increase, that is a movement. Increase in deferred tax, that is a movement in deferred tax. Deferred tax is a provision. Increase is treated as an additional expense. So we have increase over here. We'll be increasing our current tax. So we go and add that particular. Okay, we'll be adding 4,200. Okay, 4,200. What will be the final figures now?
For 2022 will be 17,000.
17,000.
Yes, confirmed.
And this will be
8,000.
1,000.
Okay. So tax expense charge, the one that I'll be taking to profit or loss is these figures. So you bring them and you find your profit before interest and tax. A very simple one. Okay. So you have 19 plus 6 plus 8. Then we have 33,000 for the
So the
first
tax
year.
expense should be in brackets. Yeah.
No, we are finding profit before interest and
Okay.
tax.
Okay.
Right.
All right. Okay.
Okay. So 40
That's
plus
good.
9 plus 17. I'm having 66,000. Okay. By mistake, you can just multiply the first one by 2. Okay. So that is it. Yes. Okay. So we have 66,000 here. This is just to open your mind to the possible options that you might be having in the exam. Okay. So you should be on the guard that anything is possible. You should be there. You should go there and be thinking that you are going to be doing any ratio. They can even give you cash flow. How do you go about it? Okay. That is also an issue on its own. So with this one, I'm sure that anything can be calculated now. Okay. With this one, anything can be calculated now. So let me look at the remaining ratios now, and anything can be calculated. Okay. Operating expenses to sales ratio. Okay, so let me calculate all the ratios. There's no problem. Let me calculate all of them. So let's come to, okay, what is the net profit margin for the first year? I'm having 18.1%.
And then 15.1.
Okay, 15.1%. So the next one is what? Operating expenses to what? To sales ratio.
Sales ratio.
Okay, operating expenses to sales ratio. Operating expenses. Operating expenses to sales ratio. So that will be operating expenses divided by revenue. How that is correct? Multiply by 100. So our revenue now is 365,000, and this is 219. We have to find our operating expenses. So how do we find our operating expenses now? How do we find net profit before interest and tax? It is the gross profit minus what? Net profit before interest and tax is going to be, in this particular case for the organization, is going to be the what? The gross profit minus what? Minus the operating expenses. The entity has only 4 classification of expenses: cost of sales, administrative expenses, which is operating expenses, finance cost, and tax expense. So the profit before interest and tax is calculated as the gross profit minus the operating expenses. Then we have profit before interest and tax. Then we have now taken tax and finance costs, and we have profit for the year. So your operating expenses will be calculated like this. Okay, your operating expenses. Okay, so let's come here. How do we calculate net profit before interest and tax? Okay, net profit before interest and tax is calculated as the gross profit minus the what? Minus the operating expenses. Okay, now we are looking for operating expenses. What we have to do is we have to add so we'll be having the operating expenses over here. So we have the operating expenses over here. Then we'll be having the gross profit minus what? The net profit before interest and tax. That will be our operating expenses. Because if you subtract the operating expenses from gross profit, that is why you have net profit before interest and tax. So now you are looking for operating expenses. It means that you take the net profit from what? From the gross profit. So let's calculate the operating expenses for each of the years now. So we have operating expenses. That will be 2022 here and 2021 here. So the current series at the top, and we move on. So we have our gross profits. So gross profit will give us, we have calculated the gross profit for each of them. That
Yeah,
one
63,000 for 2021.
Okay, 63, 2021,
And 2022, 146.
146. Then we now take the net profit before interest and tax from them. So we have 33 over here, and we have
56.
66 here. So what are we having?
Twenty 113.
Is it 113? 146 minus 66.
Hey, sorry.
80.
Okay. So,
80.
so we now have the 80 over here multiplied by 100 and 30 over here multiplied by
30,000.
100. Okay. So that is it for that particular one also. Okay. So we come to return on equity. How do we calculate return on equity? Return on equity, how is it calculated?
Profit after tax minus preference
Return
dividend divided by
Profit after tax minus what?
preference dividend.
Okay. Divided by
Equity.
Okay, shareholders fund. Okay, if you say equity, someone might be using the share capital. Okay, so the profit, the return on equity is what? What is the profit? What is the profit that we are giving on what? On the investment, on the total shareholders fund. What is the total shareholders fund? Okay, they have the share capital and they are reinvesting the what? The profit. So the total amount that they have will be the share capital plus the retained earnings. Please look at this one. If this particular preference share should be treated as non-current liability, okay, if this one should be here like this, preference share capital, please, it means that this is a redeemable what? Preference shares, which the interest has been taken or the dividend has been taken to profit or loss as interest. But come here, they are treating the preference share capital under equity. It means that this is irredeemable preference shares. Irredeemable preference shares, which the dividend will be taken to statement of changes in equity. It is treated as if it is what? Equity instrument. So for this reason, we are going to be taking the preference dividend from it. But if the preference share should be treated as non-current liability, please, that is a redeemable what? A redeemable preference shares. If dividend has been treated as what? As a finance cost, so you don't have to take anything away from your profit for the year. So this is what we are going to be having over here. So we have the return on equity. Return on equity will be the profit after tax minus the irredeemable preference dividends divided by shareholders fund. Okay, how do we calculate the shareholders fund? The shareholders fund, this will be multiplied by 100. The shareholders fund is the what? Is all the equity items. So the share capital plus revaluation surplus plus retained earnings and whatever we are having there. Okay. So we have, what is our profit for the year? We have determined the profit for the year somewhere. Okay. Profit for the year was 19 and 40. How that is correct?
Yes, sir.
Okay, 90 and 40. So we have 19,000 minus a preference dividend of 5,000, 10% on 50,000 every year. That will divided by what is a shareholders fund, equity, and the retained earnings. What are we having? Equity and the retained earnings 2022. I'm having 210.
Yes, sir.
Okay. So 210. Then we have what is the 40,000? We have the 40,000 minus the 5,000, which is the preference dividend is 10% on their total amount. Okay. That will give us how much? What are we having
I
there?
think the figures have interchanged though for the profit for the year.
Oh, okay. So 40 is for 2022. Okay. So 40 over here, 40,000. So we have 40,000 here. And we are going to be having 19,000 here. Okay. Divided by what is the share capital? What is shareholders fund for? So you have 100 plus 55. I'm having 155.
Yes, sir.
Okay. 155 multiplied by 100. Multiplied by 100. So the answer that you're having, you put it there, and you have the next one. Okay. The next one, return on capital employed.
Sir, please, you mentioned that the redeemable preference shares, the returns on the redeemable preference shares are already computed into the finance cost.
They are
So
treated
we
as
have,
financial liability, so we don't do anything about them. We only take the dividend of irredeemable preference shares.
okay, thank you.
Yeah, yeah. Return on capital employed. What are we having? Return on capital employed. So we have return on capital employed. The capital employed is the total capital that has been the total long-term capital that has been invested in the company. So what will happen is that since we are going to be using debt, we take out the effect of the debt. So we have net profit before interest and tax over the capital employed or the net assets multiplied by 100. How do we calculate the capital employed and then the net assets? It is the shareholders fund plus the what? Plus the long-term debt. Okay, plus the long-term debt. And you have to be very careful with the long-term debt over here. Okay, long-term debt that we have over here is going to be only what? What will be the long-term debt for 2022? Long-term debt for
The
2022.
not the interest bearing.
Interest bearing plus what? Preference shares are what?
Preference shares,
Yeah, preference.
irredeemable.
So what we do over here is our capital employed. So our capital employed will now be the 260 over here plus 50. How that is okay? $260 plus 50 for 2020 what? 2022. Is that correct? Can we confirm that? 260 plus 50 capital employed. Equity shareholders fund plus what? Long-term debt. And that is going to be the what? The 260 plus 50. That is the capital employed. So we have the shareholders fund, which will be the share capital plus retained earnings. The preference shares, they are also investment. Their part is also capital that they are putting in the company. Please, deferred tax does not what? Deferred tax is not an amount that you are putting there. Deferred tax does not earn interest or does not earn return. Capital employed, we are talking about those long-term what? Long-term capital items that will earn what? A return. Return on capital employed. So we have the preference shares, we have the share capital itself, we have the retained earnings, and we have the interest bearing or other long-term what? Debt. That will be 260 plus this one, and that will give us the 310. So we are going to be having net profit before interest and tax to be 66,000 divided by 310 multiplied
So,
by
sir,
100.
does it mean we've added the retained earnings?
Yes, please.
Okay.
Okay. So we come to the next one. We have 33,000. 33,000 and 33,000, and that will give us 295,000. Okay, 295,000. The retained earnings that you are putting in the company will be giving you a return. Instead of you to be using the profit for something else, you are putting it into the company. It will be giving you a return at the end of every year. Okay, not only the share capital, the shareholders are reinvesting their earnings. That will be part of what? The capital that they are putting in the company. Instead of them putting the profit somewhere, they are reinvesting. That will be giving them a return. Okay, so return on capital employed is this particular one. Let me see what else. Okay, let me see what else. I'm sure
Sir,
current
please,
ratio.
if we are to calculate the current liabilities, are we to add the deferred tax?
Deferred tax is not a liability.
Okay, good.
Deferred tax is not an amount that you are going to be paying. Deferred tax is not a liability. Okay, so let's come to current ratio. Current ratio is current asset over what?
Hello, sir.
Yes, please.
So the deferred tax under the non-current liabilities, when we're doing the tax schedule, we didn't use it. So what is it purpose?
Deferred tax over there are the liability items. That is at the deferred tax at the end of every year. The one that we take to profit or loss is the movement in the deferred tax. What is the provision at the beginning? What is the provision at the end? Deferred tax has increased by this amount. We use increase or decrease. We use movement, not the figure. Okay.
Hello, sir.
Yes, please.
The net asset we talk about, is it the capital employed? Is it not the same as total asset minus current liability?
No, please.
Why is that?
If you have deferred tax is not a liability that you are going to be paying. So doing total asset minus current liability will give you a wrong figure like what we are getting over here. So if you don't have deferred tax, that is why you are going to be doing total asset minus current liabilities. But if you have deferred tax, you add the deferred tax to what? To the figure that you are going to be subtracting for the total asset. Because deferred tax is not a money that is going to be what? Deferred tax is not money. If you are talking about return on capital employed, we are talking about return on those money that we put into the business to what? To make a return. So it will be the share capital plus the return earnings that you are reinvesting and the other interest bearing instruments or other long-term debts. Those are the things that the owners are going to be or the holders are going to be expecting return on. Those are the things that we call capital employed. Deferred tax is just it's just an adjustment or just an assumption of what is happening today and the tax implication on it. It's not an amount that you are putting out there to earn return. So it's not part of the capital employed. So if you are doing total asset minus total liabilities, that would be wrong if you have deferred tax. Okay, so you have current assets, current ratio, and over the current liabilities. That is going to be the current liabilities over here. They have given it to 55 and 57, and current assets will be 130 and 105. So you calculate this one. I've seen a question. Someone is talking about Why are we not adding the preference shares arriving at the shareholders fund? They are asking you for return on equity. Equity is the what? The shares owned by the owners. Preference shareholders are not owners. Either it is redeemable or irredeemable. Preference shareholders of any form does not give ownership. We are talking about return on equity, the shareholders fund, the amount relating to the owners of the company. Preference shareholders are not owners. Equity is for owners. Okay, let's come to the debt to equity. The debt to equity is just the preference shares, which is the irredeemable preference shares, plus the interest bearing over the what? So we have the debt to equity, which they can also call the capital gearing, or sometimes they can make it capital gearing, but the debt to equity is just the what? Debt to equity is just your long-term what? Long-term debt capital. Okay, long-term debt capital. Okay, divided by your shareholders fund. Okay, shareholders fund multiplied by 100. This particular ratio is different from capital gearing. A question can ask you capital gearing. The capital gearing is the what? Is the advanced form of the debt to equity. This one we are looking at the total capital composition. So out of the total net asset, what is the portion that has been financed by what? By long-term debt. So we do the long-term debt capital over the long-term debt capital again, plus shareholders fund. So we do it on total basis. The total capital structure of the company. What is the composition of what? Debt of the what? The total one. Okay, this is what you do. The question will be asking you to write reports. Okay, how do you go about the report? The question will be asking you for what? The question will be asking for a report. This is 2 years. Okay, please don't go there and be what? And be throwing things that are not true in your what? In your report. Okay, this is on year-to-year basis. The report, you have your format of the report there. You have the two, maybe the chief finance officer or CEO. From you, the person, you can name yourself financial accountant or finance officer or anything that will be telling you over there. So finance officer, you write the date you can use the reporting date of the date at the top of the financial statement. Then you have the subject. Like the subject is just like topic, analysis of the financial statement of the company. Then you have your introduction, you do your introduction. Okay. You do your introduction. Let's go to what the report is saying. Let's look at what they are asking you to do. So the question is asking you to prepare a report and address the chief executive officer, analyzing the financial performance and financial position of the what? Of Ashton Limited for the year 2022. Okay. You can what? You can write this report like this. Okay. You can write this report like this by saying, so you just come here, you introduce this one. Okay. As discussed, I hereby present to you the report on the analysis of the financial statement of Ashton Limited relative to what? For the year ended 2022 relative to what? To 2021 financials. Okay, this report should be read together with what? With the appendices. Or the report has considered so many things, the information provided by the financial statements and other relevant information in the industry or relating to the industry in which the entity operates in. Anything that we are going to be saying, just introduce it in a very simple terms and move on. Okay. This one, the question is not asking you to do it in the what? In the issue of liquidity position, in the issue of what? Gearing position, in the issue of what? Profitability position. But if they are asking for financial performance, you have to know that financial performance will be seen in the what? In the profit or in the return that they are giving to what? So you can just write financial performance over here. Okay. Then what are the things that is going to be determining the financial performance of? Yes, please. Report and memo take the same format. Okay. So financial performance. What are the things that will determine the financial performance of the entity? That will be the gross profit margin. So you can bring in the gross profit margin under this one. You talk about what you have seen from the gross profit margin. You bring in the net profit margin. That will also determine the performance of the entity. Then you bring in the ROCE, and you also bring in the return on equity, the ROE. Okay. You can also try to what? This financial performance and financial position, you can try to analyze it from this perspective. You do the analysis of the financial performance to the profitability, where you will still be talking about these ratios. So you can talk about profitability analysis that will measure their performance. Okay, so profitability analysis. Then you come here, you do, I will tell you what you are going to be doing. You have your financial position and talk about the ratios that are going to be looking at the financial position of the entity. The financial position will be the current ratio, okay, the current ratio and the debt to equity. Okay, so those are the two ratios that you have calculated. So debt to equity. The financial position also, you can also split it to talk about issue of liquidity, or you talk about issue of liquidity analysis, then you talk about the issue of gearing. The debt to equity is the gearing ratio. So you bring the current ratio under the liquidity and talk about what you have seen, the reason for that, and you bring the debt to equity ratio to this one and talk about that particular one. So let's come here. Let's come to financial performance. Financial performance, we are going to be talking about those ratios that are measured in terms of profitability. Okay, so let's come to the figure that you have here. I will just talk about the two, how you do, if it is year by year. If you are doing inter-year what comparison or comparison for 2 years, how do we go about it? Let's come here. Okay, for the 2022, what are we seeing for the profitability ratio? What are we seeing for gross profit margin? 2022 and 2021. What can you say about that? How do you go about this one? What can you say about the performance in terms of what gross profit margin, the ratio that you have calculated? What can you say about the 2 years and how can you say it? What can you see over there? What can you see over there?
There has been an increase from 28% to 40% the current year.
Okay. Okay, that is nice. That is nice. That is not bad. So there has been an increase from 28.8 in 2021 to 40% in what? In what? In 40% in 2022. This represents what? A significant or a slightly increase in revenue. If you cannot quote, please, the change, we don't find the change as 40 minus 28. No. The change will be 40 minus 28 divided by 28 multiplied by 100. So if you want to quote that particular figure, then if you want to quote the change should be calculated as how we calculate the change in the value. It will be the current value minus the previous value divided by the previous value. This is how you are going to be quoting the change. So this represents what? Then the answer, this represents, let's say, 15% increase in the what? In the revenue for 2022 as compared to what? 2021. Okay, that is one way of going about it. You can also say that gross profit margin, there have been a significant or there have been a slightly increase in the gross profit margin of the entity in 2022 as against in 2021. The gross profit margin for 2022 is 40% against what? 28.8% in what? In 2021. This means that in 2022, the entity was able to what? To return 40% or 40 pesos of every 1 cedi that they are, every 1 cedi of revenue that they are generating. They are able to what? Spend only 60% on what? On their cost of sales, as against what? These people spending 72% on cost of sales in the 2021. Okay. This increase in performance is due to this reason. Please look at this. Don't go and say that the entity have incurred, the entity has now advertised, they have reduced their selling price, they have increased their volume of their sales, they are able to manage costs very well. Please, these reasons are some things that are not going to be supported by any figure. You are giving financial statement to write a report. Whatever you are going to be using as a claim should be supported. If you are doing year-to-year basis, the increase over here is as a result of this. Let's come here. So the increase over here, this is what you are going to be saying as the reason for the increase in that particular one. You come here. What are the items that you have used? What are the items used in the calculation of gross profit margin? It is a gross profit, it is a gross profit for each year and revenue. So what you do is you find a change in the items used because that is 2 years. Find a change in what? Find a change in the two items. How do we find a change? The change will be calculated like this. We come here. Revenue was 219. Now it is 365. So the change in the revenue will be 365 minus 319 divided by 319 multiplied by 100. What is the change in revenue?
It's 40.4.
Okay, 40.4. Okay. Then you come here. What you do is, okay, what would you find find a change in the cost of sales. Okay. So, oh, that is someone is saying that it's 219, not 319.
So 14.4.
So someone is saying it's 219. 219. Okay. So it's 219, not that one. So let's see what we are getting. Maybe 66.7.
Yeah, 66.7.
Okay. So the revenue has increased over the year by 66.67. We have subtracted cost of sales to get what? To get the gross profits. So let's look at the corresponding change in the what? In the cost of sales. Let's look at the corresponding change in the cost of sales of the entity. Let's look at the corresponding change in the cost of sales of the entity. What will be the cost of sales? The cost of sales is here. So we have 290 minus 156 divided by 156 multiplied by 100.
40.3%.
40 point what? Sorry. Okay. 40.3%. You can see that the revenue is increasing at a rate higher than what? The revenue is increasing at a rate higher than what? Than the cost of sales, isn't it?
Yes, sir.
Okay, that is why the gross profit is increasing. The increase in the revenue in the previous year is higher than the increase in cost of sales. So we are getting more revenue and we are incurring what? Less cost. The revenue that we are getting is higher than the what? Than the cost. So the reason for the increase in the what? In the gross profit margin over here is as a result of the increase in the figures that we use to calculate the what? The gross profit. The increase over here, which is a 40 against 28, is as a result of what? A higher percentage increase in revenue as against what? A lower percentage or a low corresponding percentage increase in what? In the cost of sales. So you put the percentages there. This is as a result of the revenue is increasing at a higher margin, which is 66.7% as compared to the increase in the cost of sales over the year, which is 40.3. That is how you support your claim. You don't have any information about whether the entity is doing advertisement or they are managing their costs. Well, there is no information there. So you just use the information that you have. capitalize on the information that you have and support whatever claim that you are saying. If you are doing it year by year basis, look for the change in the items that you have used, or look for the change in the items that you will be using to find the what, to find the figure, or to find the figure that you are using to calculate the what, the ratio. It is gross profit margin. It's the difference between revenue and cost of sales. So if cost of sales is increasing more than what revenue, gross profit will be low. If revenue is increasing more than cost of sales, gross profit will be very high. So the increase over here is as a result of the increase in what? In the revenue and also the what? The cost of sales. So the revenue is increasing in the current year higher than the what? The previous year. And the cost is very low. That is the reason. Don't go there and be saying that the entity has carried out advertisement, they have reduced their selling price, that increases. No, those are imaginations. Those are imaginations. I saw a hand up. What is the issue?
Yes, sir, please. Do you show these workings in the answer sheet?
You
The
write,
increase.
just write the percentage there. Calculate it somewhere and write the percentage. Are you okay?
Okay.
If you want to show everything for this one, please, there's going to be a time for you. If the examiner want to confirm, he will go and calculate what you are saying. Okay.
Yes,
You are
sir.
just adding this one to what? To, yes, please, whatever is the cost, take the cost from the figures that you are having. If you are doing it company by company, gross profit margin, you are comparing company A to company B. You are doing what? Just a year for them, company A and company B, and you have gross profit margin. Please just find their cost to what? Revenue ratio. What do I mean by their cost to revenue ratio? Let's come here. That one of them will be having cost of sales, and the other one will be having what? Revenue. So you just find their cost to what? Revenue ratio. How much are they, for every sale that they are making, how much are they spending in terms of direct cost? And you look at the second one too. Okay, the one with the lower level of cost, or the one with the higher revenue or cost to revenue ratio will be having a low gross profit margin as compared to the one that is having a low one. So you can use the cost to revenue ratio. What is the proportion of the revenue that is being spent on what? That is being spent on cost. So one person is doing better because one person is what? One person cost to revenue ratio. One person is spending less on their cost, on their direct cost, as compared to the other one. And that is the reason for what? For the increase or for the better performance. We just use some figures to do that one. If you are done with the figures, then you can bring in those outside assumptions that are not part of what? That you cannot dictate in what? In the question given to you. Okay. So the net profit margin, you take your what? You take your total cost. You can find the total cost ratio to revenue. So increase in the total cost. What will be the total cost? Cost of sales plus the operating expenses, because we are using net profit before interest and tax. So cost of sales plus operating expenses. Then you find the change in it, and you find the change in the revenue also. The revenue will be increasing at a rate higher than the cost, the total cost. That is why our net profit margin is increasing. Okay. Please. Okay. So I cannot write a report, and that is how you go about whatever you have seen, whatever you have seen, whatever you have seen in the calculation. Please say what you have seen in the calculation first before we talk about the possible causes of what you think. Possible causes of what you have seen. We talk about the possible causes. Okay. This increase, you think that is because of this particular one. That is it. And if after writing a report, you do recommendation and conclusion. The recommendation, you talk about the ratios that the entity are performing badly. You advise them on how to what, how to improve those ratios. Example would be current ratio. So the liabilities might be higher than the current assets. How do you advise the entity? You can advise the entity to talk to the what? To the long-term holders to convert the liabilities to long-term liabilities or to equity shares. So you can advise them on that one. How do they improve their profit margin? Okay, you can advise them that they should look for alternative for sources of what supply, which will be at what at a lower cost, or they should now buy in what in bulk to take advantage of economies of scale. Those are the those are the recommendations. Give recommendation on the ratios that are not good, that are very bad. You give recommendations on the ratios that are very bad. And the conclusion, you just conclude what is the position of the entity. In the 2022, the entity seems to be performing better in all aspects as compared to 2021. That is it. We'll move on. Okay, let me talk about the issues of cash flow. Okay, they can ask you to do common size analysis. We have done a common size analysis. They can ask you to do cash flow. Okay. They can ask you to do cash flow. Okay. They can ask you to do cash flow. The cash flow, if it is 2 years, okay, if it is 2021, 2022 for the same company, okay, if it's 2021 and 2022 for the same company, what you do is that you just find a change in each of the figures. Find change in important figures. Okay, find a change in what? The important figures. The important figures will be you can find change in the profits or change in the net cash flow from operating activities. Net cash flow from operating activities. You find change in the net cash flow from investing activities, change in net cash flow from what? Financing activities. Okay, what is the change? The change over there. Then you now go and what? Talk about the things that are bringing the change. If the change in 2021 to 2022 is what? Is 25%. There is an increase of 25% in what? In the cash flow performance over the 2021. What do you think is bringing this particular issue? It might be their profit for the year that is actually causing that particular one. So you use the profit for the year to explain why this particular change is coming. It might be their changes in their working capital items. Okay, you attribute the 25% change to what? The changes in the working capital items. Okay, the cash flow position of the company in 2022 is improving because of what? Improvement in their profit for the year, or because of the improvement in the what? In investment in their working capital items. So you look for the figures that are likely, those figures that are very high. If there's a decreased change, those figures that are negative, those figures that are reducing, those are the ones that you are going to be using as the causes for the change. So if you are doing cash flow for 2 years, that find the change. Do just what? Horizontal analysis. The change in the important figures, most especially the change in cash flow from operating activities, change in cash flow from investing activities, change in cash flow from what? Financing activities. Then you look at the net change over the 2 years, and also look at the change in their cash flow itself, the cash balance. Then you now title your report as cash flow from operating activities. You talk about a change over there. You explain the items that are the causes, or that are the possible causes for what? That particular change for each of the items. That is how we go about the cash flow. If you're using company by company, you can find the what? The percentage of their items. One person will be having a figure higher than the other person. Why is this person having this figure higher than that person? It's because of the composition of that particular figure. You use those figures to explain why this person is doing better than the other one. That is about the cash flow performance also. Seniors, it is many at my end. If you have any questions, you can come with it.
Hello, sir.
We end it over there. Yeah.
Good afternoon, sir.
Yes, please.
So please, when it comes to the cash flow, the changes, are you going to do it based on year by year?
Are you going to be doing it for?
Are you going to the change in the cash flow?
Yeah.
For instance, if they give the year 2020 and 2021, are you going to do the change against 2021 to 2020, or we are using the what's the name?
The
value added.
The change that you are going to be looking for. Okay. Mostly the change should be from the important items. So what is the net cash
Okay.
flow from operating activities for 2021? That is for 2022.
Okay.
How do you find a change? 2022 figure minus 2021 figure divided by 2021 multiplied by 100. So you find a change in the what? In the major items. Net cash flow from operating activities. The change over there is 25%. You title your report as cash flow from operating activities. Okay. The cash flow from operating activities of the entity has experienced what? An increase of 25% over the 2021 year. Okay. This particular increase is as a result of what? A significant increase in the profit for the year of the entity. This particular increase is also from a significant increase in the what? In the net cash flow from working or net cash change or a change in the working capital items of the entity. So you find a change from the important items and use the composition to explain why that particular change is there. Don't do the change year by year. You do finance cost year. You do profit for the year, a change. No, please, if you do that, that is going to be taking your time.
Okay, sir. Thank you very much.
Okay.
So what if it's 3 years? So we have 2022,
If it is
2023.
3 years, if it is 3 years, you can, if
Base
it
year
is,
will be.
okay, if it is 3 years, you see that you'll be doing 2021, 2022, and 2023, isn't it? Okay. What you can do is that under normal circumstance, you have to compare 2022 to 2023, 2021, and 2023 to 2021. But if you want to save time, please, you can just do the what change between 2021 and 2023. Okay. 3 years will be too much for you. You have to compare over the what? Over each of the years. But you can use 2021 as the base and express the percentage change of what the current year, which will be 2023, and against 2021. But within the report, you can also be talking about the what? The increase in 2023 as against 2022. But doing it that 2021 for each of the items, that is going to be taking your time. But under normal circumstances, you should do 2021 against 2022 and 2022 against 2023. But maybe the question can limit you to 2022 and 2023. Okay. But if they are giving you the 3 years, okay, if you have time, you are going to be calculating only cash flow from operating activities. But that is going to be taking your time. If you want to do it for each of the years, 2021 against 2022, 2022 against 2023, that is going to be taking your time. So you can just look for the change over the what? Over the 2 years, which will be between 2021 and 2023. And now use the change over here to generalize what? The whole issue. It means that this will increase 25% over the what? Over the 2 years. What do we think might be the reason for the increase over the 2 years? You find a change in the items also over the 2 years and use it to explain why you think this particular increase is there.
Yes, sir. So if I understand what you're saying, so meaning that if it's for 3 years, then the base year for, let's say we are doing the analysis for 2022 and 2023. So
Yeah.
the base year is going to be 2022 minus 2021 divided by 2021. And then for 2023, it's going to be 2023 minus 2022 divided by 2022.
No, if you are doing I've gotten your question to be, you are doing the analysis for all the 3 years. Okay. If you are doing for all the 3 years, then your base should be 2021. You are comparing from 2021 to 2023. Your base should be 2021. But if you are doing for 2022 and 2023, this figure is not important. You are comparing 2022 to 2023. So your base will be 2022. I don't know whether you have gotten my point now.
So, yeah, I've gotten it. It's clear.
Okay. So, but if you are doing over the 3 years, then your base, you are comparing from 2021 to 2023. So you now use your base and ignore what you are going to be doing over here. Because that's, if you want to do for all the 3 years, it will take your time. But if you are doing 2022 and 2023, 2021 is not relevant because we are not comparing anything with 2021. Okay. Please, any other issue? All right, if there are no other issue, I'll make the question available on the external reconstruction. Then we find a time and try that one. It's not different from the normal reconstruction, but what happened is that we are going to be forming a different entity, and all the reconstruction that we have done, all the figures will be sent to the new entity now. It will not be in the reconstructed thing again. It's not any issue, but I will find question that and we look at that one at the right time. All right.